high is the Fed going to have to go? Because the Fed's not going to quit until the labor market quits.
The data clearly suggests that the Fed needs to continue to tighten.
Depending on what we see from the inflation data, we could see another rate increase.
There's still a long way to go in terms of bringing inflation back down to the Fed's target.
Things are moving in the right direction, but gosh, we really want it to go faster.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Here we go again, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market, equity futures just a little bit softer going into CPI later this week. And earnings season, TK earnings season kicking off on Friday. JP Morgan, Citi, Wells Fargo, just around the corner.
And as we said here, and John, particularly when you were away, Lisa and I really focused on this, and Lisa really decided she was going to dive into it. This time is different. I think that after CPI Wednesday to start earnings Friday is a huge mystery, and we'll be a little bit smarter, 2.5, 3 weeks from now.
Is CPI Wednesday catching on?
CPI Wednesday.
Just ahead of PPI Thursday.
Brought to you by Bloomberg Surveillance.
Welcome back. All the data coming up after payrolls, and payrolls for most people disappointing relative, not to the estimate, but relative to the ADP report, leaving the door open for another hike of the Fed later this month.
What happened? I go on vacation, ADP matters tremendously. All of a sudden, that's the most important number. That's going to shake up markets. And then people look at the actual data from the U.S. government and say, who's wrong? We're not sure. And the angst arises. My question is, how much are people bringing forward some of the rate hikes? And will they get confirmed by the CPI print, making it impossible for the Fed not to hike at this month's meeting and potentially even in July?
Yeah, I think all the data over the weekend, I thought it was a really rich weekend for people thinking about this. Mike Wilson reaffirmed some earnings challenges as well. But the one statistic that stuck out to me, and I'm going to give the economists credit for this, I'm not sure where, is prime age America, prime time America. I'm not prime age America. John, you're not Lisa's prime age America. Prime age employment
that
is
got someone
back.
in trouble once, TK. I don't think you want to go there.
22 years, 22 years,
boy.
I say. Lisa, we are fully employed around all these challenges at 80% plus prime age employment.
I will say I was on vacation last week, and the amount of spending is dramatic. The amount of inflation is dramatic. The amount of people who are saying help wanted in every single storefront is still the same as it was a year ago, even at a time when we're talking about a slowing economy. So to that point, how does the Fed deal with not necessarily the year-over-year comps, but the last mile? And that, I think, is what a lot of people are going to be talking about, with a stickiness underlying some of the inflation we've seen.
Precisely what Sarah House of Wells Fargo said on this program many months ago. Just for the record, we are all in our prime. We agree on that. We're all in our prime.
100%.
Okay.
Well, I'm so
prime for everybody.
Good. Let's just move on.
I'm like Transformers.
Futures on the S&P.
Oh, boy.
Negative 0.2%.
Just trying to save you.
3-day losing streak on the S&P 500 and on the Nasdaq as well. Let's see if that goes into day 4. In the bond market, yields just a little bit higher. Let's call it unchanged on a 10-year, north of 4%. Earlier today, inflation data out of China. Seemingly the takeaway from that, Lisa, just opening the door, leaving the door open to stimulus out of China if they want to.
Deflation, outright deflation, now a concern, which is just kind of shocking, given the fact that everywhere else is worried about combating inflation. We're looking at today, President Biden is meeting right now with UK Prime Minister Rishi Sunak. This is ahead of course, going to the NATO meeting that starts tomorrow in Lithuania. Very curious to hear what kind of consensus they can get on allowing Ukraine into NATO at a time when NATO doesn't want to be in an active war with Russia. I mean, that's sort of one of the key questions here as they debate this. Today, Fed speak galore. Fed Vice Chair Michael Barr at 10 a.m. San Francisco's Mary Daly at 10:30 a.m. Cleveland Fed President Loretta Mester at 11 a.m. Atlanta Fed President Raphael Bostic at noon. Are they going to say anything that's going to be useful?
Let's stop here. This is important. What's the so what here, John? What are we gonna know at 4 p.m. this afternoon? Remains closing the markets. What are we gonna know from these 4 we didn't know before?
Well, what we know so far is this division on the FOMC, captured by the most recent minutes, and we're going to find out who's who wanted to make a move in June but didn't because they want to wait until July. And I would say take July out of the debate. Bramo, this is about September and beyond. This is about how do you reset things at the end of August in Jackson Hole and push on from September.
Especially at a time when there is a key question of why the resilience in equities in credit at a time when yields are going higher. Does that mean that the implied neutral rate is significantly higher than previously expected? At 3 p.m., the last thing I'll leave you with, Fed is releasing some consumer credit data for the month of May. The previous read showed the biggest uptick in borrowing in 5 months. How much of the boom in consumer spending is what I did on my vacation, which is charge it to your credit card and leave it there. And you've seen the credit card outstandings absolutely skyrocket over the past few years.
And I know we got to keep going here, but in the new regime of interest rates, do we breach a 30% per year on credit cards? Can they do that? I don't know. I'm just asking, but up go rates.
You're going to pay that statement off, Bramo?
I'm going to pay that statement off at some point. No, I will pay that statement off. I don't like having credit card.
I did the same thing just to collect the points.
Oh, yeah, come on. This is the biggest con
back,
job.
All that, absolutely.
This is the single. I hear this at home, John. I'm doing this for the points. I have to pick up a beverage of my choice when somebody does this.
Do you not do that on vacation? You do it for the points?
You're killing me. God, the echo here.
Laurie Calvasini joins us now, head of US equity strategy at RBC Capital Markets. Laurie, wonderful to start the week with you. We're just reading a note from Barclays, and they said this: we don't see the tech-centric rally broadening to the rest of the S&P 500. We've got bank earnings on Friday. Do you see that rally broadening out?
Well, thanks for having me, as always. And look, I think this market wants to broaden out. We've seen the small cap part of the market make several attempts to fight back. We have looked at financials, earnings revisions as well in particular, and we're seeing that they're generally in negative territory, but they've been getting a little bit less negative. Same thing on energy. When we look across the S&P, most sectors are in recovery mode in terms of earnings sentiment, which means their rate of upward revisions has either flipped from negative to positive, or they are starting to get less negative. So I think this is a market that has really done well on the backs of the tech sector, kind of the broader TIMT space so far this year for good reasons. But I do think that, especially from the earnings perspective, there are some healthy undercurrents going on in other parts of the market as well.
Laurie, I'm looking over the weekend. I thought there's a lot of really good equity zeitgeist as we get ready for the roulette wheel starting Friday with JP Morgan. And the answer I see is a massive strategist bet that's pretty darn negative. Is that what you observe out there? There's a pretty gloomy strategist tone forward?
I think so. And, we've talked about this before. My target is 4,250 on the S&P. I've pointed to potential upside to 4,400, 4,600. 3 of our models are bearish. 3 of our models are bullish. The 4,250 is splitting the difference. But even in that context, Tom, and I tell people, I personally feel pretty neutral. I don't feel like the market's been crazy. I do see the potential for some upside, but this is a December 31st game. So any incremental upside, you might get some profit taking. All of that, Tom, people keep telling me I'm one of the big bulls out there on the street, and I just kind of laugh. Right. But I think the reality is that there's been this view that the earnings expectations are too high, need to come down, pummel markets. I don't, we could walk through that later, but I think that just, interprets how stock prices discount stuff like that in advance and did it last year. But I also think that this is a unique moment in history. And so if we do have a recession, I think, we were all talking about it last year as technical in nature. I do think the market has the ability to focus on the bigger picture and might not be as damaged by that as some assume.
Give us 2 attributes when you screen for quality in mid-cap, small-cap. I get it. I can screen for quality in the world of Apple. But how do you screen for quality in mid-caps?
I think it gets tougher when you get down into the small mid-cap space. One thing we talk to a lot of clients about is healthcare and technology. That's where a lot of your loss makers are sitting in the Russell 2000. So if you were to screen in small cap, say on positive negative earners, on things like ROE, especially on that positive negative earners, you're going to come away with the idea that technology is a low quality sector, that healthcare is a low quality sector. Sometimes, we see that investors are like, okay, fine, that's just what the data is. We like these factors over time. Let's just let that work in the filter. But right now, there's a more nuanced discussion happening in the small cap space, which is that if we're going to have sort of a subpar economic recovery, and next year the GDP stats, and even for 2025, are both comfortably below 2%, which is the long-term trend. In a subpar economic backdrop, you want to buy growth stocks. So people are having to look at things like tech and biotech and healthcare and say, okay, our losses, is that necessarily low quality? Not necessarily. You really have to do it more from an art than science perspective, take into account the data, but also take into the long-term growth dynamics.
Laurie,
talent of management team is something else you have to look at in small cap as well.
Laurie, how much do you push back against people who say that stocks are just ignoring this feeling in bonds that perhaps we're underpricing the risk, the Fed has to go a lot further, that the real neutral rate is significantly higher, and as you can see the real yield go higher, you're not seeing that commensurate sell-off, even in small caps? How do you rebut that?
So it's interesting, Lisa, in sort of my late June, early July conversations with U.S.-based investors, they keep asking me about balance sheets. And I think that's really where the interest rate discussion intersects with the ability of companies to manage through this higher rate environment. And we talk to people about how I think only 2% of S&P companies have an effective or have an average weighted maturity of under 2 years. And the Russell 2000, even, it's less than 10%. So, and we have a lot of other metrics we take people through, right? So long-term debt has risen, short-term debt has come down. What does fixed versus variable look like? And what we come away with is the idea that a higher interest rate isn't as damaging to companies and their balance sheets and their ability to manage their cash flows now as it was in the past. And I think that investors and portfolio managers who are really deep in the weed are trying to wrap their head around that issue. This seems to me, this higher interest rate environment, like another one of these like 5 or 6 things since 2018. That's, a hurdle. It's a challenge, but it's something that companies seem like they're able to manage through so far. And that's giving at least some of the investors I speak with some comfort.
Does that mean, Lori, that right now Fed policy is not as restrictive as people think, and that in order to bring inflation lower to truly their goal, they have to go significantly higher because those higher rates aren't as damaging to some of these companies?
I think that higher for longer is still what I hear. I will tell you, pre-SVB, I have a valuation model where we plug in interest rates, GDP, 10-year yields, that sort of stuff, inflation rates as well. Pre-SVB, everyone wanted me to run that model at 6 and 7% and see what kind of PE estimate was spit out. I don't get those requests anymore. We've got, I think, 5.35 baked in the model right now. And people are pretty content to sort of use that as a general kind of, rough bogey for the end of this year. We've got some cuts baked in for the end of next year. People seem pretty sanguine about that. I think in general, investors want the inflation fight to be won. And if you go back to the debt ceiling, Lisa, I know we haven't talked about this in quite a bit, but I think one of the reasons why the market didn't collapse around that is I do think the equity market was on McCarthy's side and wanted spending to be reined in. So ultimately, inflation could be brought back down to more reasonable kind of levels. I think that calculus, at least on the equity side of the business, I can't really speak so much for fixed income investors, but I think a lot of the equity PMs I talk to, they want that inflation fight to be won, so they're willing to tolerate, another hike or two and higher for longer.
Laurie, just a 30-second tease if you can. I've got an article set to one side for reading later this evening. It's in Barron's over the weekend. I saw the headlines, your name, and it said something like, it's kind of like the 1940s. What's the takeaway?
So in 1945, we had a recession that the stock market completely ignored. It was a technical recession that occurred because of a transition from a wartime economy to a peacetime economy. Underlying economy was still okay, but you had a massive withdrawal of government support back then in terms of fiscal. Very, very analogous to what we're going through today and a lot of the rhetoric we've heard about recession over the past year. I think that's one of the reasons why equity markets have been so resilient. This underlying economy is still in pretty good shape, and people really understand what's happening here.
Looking forward to reading the article a little bit later. Laurie, thanks for being with us to kick off the trading week. Laurie Calvasina there of RBC really on the week ahead. Tons of data. We talked about Wednesday CPI, Thursday PPI, Friday earnings season, Tom.
It's earnings season, but Lisa mentioned the deflation in Japan. It's one of the lead stories from Bloomberg News this morning, reporting on the disinflation and deflation. And John, you nailed it with your cover-to-cover read this weekend of Barron's. The basic idea here of 47 out to 51, 52, and the collective memory and study of experts like Calvasina is the Truman-Eisenhower deflation. Outright deflation in the early 50s, and that was percolating into zeitgeist over the weekend.
I could have sworn a week ago that if you got soft data out of China leading to a conversation about stimulus, Brammer, that was good news, wasn't it?
Well, that's the funny thing about this. People are viewing this as potential slowing in growth that's even further in China, not necessarily looking at the potential stimulus that they haven't unleashed, but they clearly have an opening to at this point. So is next week going to be return of China?
It's the return of the band. I think the band's back together for the first time in about a month? Something like a month.
I know. It feels
Are we doing
like
this
forever.
all week? Is this happening all week?
We're doing this all week.
All week. Very cool. TK, you committed to that?
I'm committed.
Okay, that was not convincing. Futures on the S&P to kick off your trading week, negative 0.2% from New York City this morning. Good morning.
Is the risk of recession completely off the table from your point of view? I mean, where do you put the odds?
It's not completely off the table, but we would expect with the job market as strong as it is now, to see a slower pace of ongoing job gains.
Janet Yellen on tour over the last week, the US Treasury Secretary, speaking on CBS on the risks of a recession, following a slight bit of controversy over the last couple of days, bowing in China.
Well, I was confused. Friday, you're talking diversity or something with her?
Diversify. There's a new word. So they've been trying to draw a distinction between not de-risking, Tom, not decoupling. It's now diversify.
Right.
Bramo, what's the difference between decoupling, sounds really dramatic, de-risking, and diversifying?
I mean, I took a look at her own words over the weekend. De-risking involves attention to clearly articulated and narrowly targeted national security concerns, as well as broader concern with diversifying our supply chains, basically anything we want it to mean. And that, I think, is the key distinction at a time when the U.S. is going to possibly ban exports of chips and China is going to possibly ban the exports of the raw materials needed to make said chips. That's where we are.
I'm going to go back to Michael Rosenberg, the giant in foreign exchange. His textbook is treasured, worth a fortune on Amazon, and also the work of the academic Catherine Mann, now holding court at the Bank of England. And Rosenberg, and particularly Professor Mann, codified the psyche of this, the codependency of this. Maybe Yellen's over there in therapy or giving therapy, I'm not sure. But the answer here, I mean, everyone's vulnerable right now. Baloney. It's a codependency of Beijing and Washington.
I tell you what, management must be so thankful Bramo's back. Your headline Monday morning is Secretary Yellen went for therapy in China.
I don't, yeah, you know.
Yes.
I'm sorry.
There's only one thing to say.
But Catherine Mann nailed this 15 years ago. We are wildly codependent with China for different reasons. Why does that change here? I just don't think it changes.
Can I get your take on international relations this morning? It's the president's turn to go on tour. He lands in London. He meets with the Prime Minister, Rishi Sunak. The Ukrainians want some new weapons. President Biden's willing to provide them. Other people in Europe don't want it to happen. You've got this other issue, Tom, that Sweden wants to join NATO. Turkey's not keen. The president's got some work to do over the next couple of days.
It's a stew in the backdrop here. We'll get to this with Maria today, I'm told, at some point. And the backdrop here is a new conservatism that we see across Europe, and maybe it redounds and accentuates in America as well. We could talk about Rutte of Netherlands out as well. But the big problem I see with Europe is, and this is true of every president, they end up loving to go abroad. Going abroad is so much easier than sitting at 1600 Pennsylvania Avenue worried about the senator from Kentucky.
It usually is. This time, though, might be different. Last year, at this time, there was real consensus among NATO members about helping Ukraine. It was a real kind of come-together, kumbaya moment. Now is not. Now is a time of divergence where you've got the U.S. and Germany coming out against supporting outright Ukraine's membership in NATO, and other people saying, well, hold on a second. You're not giving them really the backing, full backing that they really need. But the issue is, how do we do that without declaring war on Russia and really engaging in World War III?
Really complex stuff. Looking forward to the coverage from Maria Tadeo out of Europe this week, alongside Bloomberg's Anne-Marie Hordern as well. It's down on top of the price section too for you, with equities a bit softer over the last 3 days. Coming into Monday, we're down again by 0.2%. It's a big week ahead for earnings, for the economic data as well. And if you go through the latest from Barclays, it's the takeaway at the moment. They've raised their price target to 41.50. It was as low as 37.25. That's about as far as the bears will go right now, as far as capitulation goes. And they say this: we think equities would remain range-bound through year-end. We do not see the tech-centric rally broadening to the rest of the S&P 500. That's going to be the debate going into Friday morning, Bramo, when we get those bank earnings.
Here's the tension right now. If the Fed is truly restrictive, is it that this economy could just slowly and softly land? Or is it that the Fed isn't quite restrictive enough? And I think that really is the key question behind the resilience that we keep seeing. And people saying, okay, perhaps we have to capitulate, perhaps we have to get into the FOMO trade, which seems to be what everyone's doing. But then does the music ever stop? Or does it just keep going like this until we're just at this new neutral that's just fabulous?
I would look at the revenue line as being the key to determine it here. And with sticky inflation, you may get a little more persistent nominal GDP, more persistent revenue. Remember the gloom 90 days ago? OMG, we're all going to die. 180 days ago,
hey, banks were dying.
We're all going to die. The bank crisis and all that. And I'm sorry, I'm a broken record. Corporations will adapt, and they're going to do it right now into the end of the year.
Bramo used that word, FOMO. This is from Mislav Matejka over at JP Morgan today. FOMO is in full swing. There is complacency being built into stocks with the VIX at the lows of its range. Mislav goes on to say, if the activity momentum does weaken in the second half relative to the current projections of no and or soft landing, Lisa, stocks are unlikely to shrug it off.
And members from his analytics team point out that you've seen a complete piling in and capitulation with asset managers and hedge funds and individual investors piling into a more overweight position in some of the tech names, et cetera, going back months and months. So this nearly 18 months they had. So here we have a situation where people are piling in, creating maybe a dynamic where there needs to be some sort of
I cuts both ways. To me, the most important chart of the week, and I think Bar Chart out on Twitter had this, is not on Threads, on Twitter. That's a whole other topic.
Who's Bar Chart? Is that a handle?
It's like a handle. Yeah, it's very valuable. These guys, these are smart value add. The strategists, Wicked Lori Calvasina, are wicked negative. They're like wicked
Is that
negative.
A real handle?
That's not true. She actually came
so.
on and she said that she was that item. Carry on, Bar Chart.
No, but I like your point that
Bar
somebody.
Chart real?
I'm going to search it right now to be sure I have that right.
Bar Chat or Bar Chart?
Bar Chart, not Bar Chat.
On Twitter? On Twitter
Why would
or
you
Threads?
think I would have a feed? Yeah, Bar Chart.
Just wanted to be clear about this.
Bar Chat would be more popular.
Go out on Twitter and look at Bar Chat.
Just want to make sure, Tom. And what's on Bar Chart on Twitter?
Smart charts, and particularly showing that strategists, like Lisa mentions, are negative, where the negative crew, they're not adjusting to bulls. Your point's taken. 3,800 up to 4,100 is all we can get.
But the low for some of the bears is getting less low because they're looking around and they're saying, hey, maybe Tom Keene is right and companies adapt and adjust. We should just keep repeating that in our heads and then we'll be just fine. And that seems to be where we are with these upgrades that we get from others.
And again, I'm going to go off the October lows. I just did it with the total return. We'll do bonds later. But the bottom line here is October was the low. We had a surprise OMG bull market. Fine. Now what? That's where we are. It's the now what earnings season.
We had a guest lined up and they've gone. So hopefully they'll come back soon. And we apologise that we never got to you. That was kind of you. On a bit of a tangent. Let's go on a tangent about the Federal Reserve. Andrew Hollenhorst of Citi thinks we go again in July in a few weeks' time. We go again in September. Morgan Stanley's Ellen Zentner was on the programme on Friday ahead of payrolls. She agrees we're going to go in July. Does not agree about September. The incoming data will not meet the bar for the Fed to deliver a hike in September. The labour market remains strong. There is continued evidence of slowing that we expect to persist over the next two jobs reports ahead of the September FOMC meeting. July debate is done with. I think everyone's moving on unless you get something dramatic later this week from CPI, PPI, and or a big surprise from elsewhere. It comes down to what happens after August into September, Tom.
And you got September 20, not like September 5 after Jackson Hole 10 days. No, it's a good amount of data after Jackson Hole. And again, it goes to the idiocy of CPI Wednesday, and, we'll have that data. But I do agree strongly that we've way moved beyond July 26th.
Do you want to finish on a bit of sport? Silverstone yesterday, Formula One weekend. Do you enjoy that?
Enjoyed it immensely.
High-speed corners, beautiful track.
Where is it? Is it like where you grew up? Is it near?
North of London, south of where I grew up, somewhere in between.
Yeah, I just thought it was great. There's a lot of it I still don't understand. This Verstappen to me, they just don't give him enough love. They're so worried about the Netflixy stuff and the battles for 9th place.
Can I just say, Sports for Dummy, they're talking about Formula One, and I'm very excited. When I came in, you guys started talking about this, and I was like, I know what they're talking about. They're talking about car racing. So
what did you observe, John?
Everyone's into it.
I know, it actually is true. Everybody is. They're talking about it. But do you think that it's actually going to have the same flavor in the U.S. and Miami?
Yeah. You know what I think about the tracks? You know what I think about these new tracks? Take Silverstone, one of those legendary tracks on the F1 calendar. It's so cool. Yeah. It's made for car racing, and I look at what's happening in America with some of these tracks. And
should Lando have pitted? Should he have gone to mediums?
Oh, look at you getting technical. There we go.
He's so proud of himself.
Did the work in the break so you don't have to. Bar Chart is real. And on Twitter. Follows me, so I'm following back. Great charts, Tom. Thanks for that.
Some love.
At Bar Chart.
We've been working here this morning. We're celebrating Grandma back. And I just got to say, folks, if you want to send in your emails or tweets or whatever, on we're doing it for the points. That's the biggest thing we've learned this morning here on economics, finance, and investment. If I get 5,000 more points, I'll become platinum.
Yeah,
doing it for the points.
I had kids for the points.
Some controversy about that.
That's brilliant.
Let's hope the kids aren't listening.
I'm just kidding.
They don't wake up
Love
at 6:30, do they?
Yeah.
No, that's the good news. Okay. Equities shaping up as follows on the S&P 500, softer by 0.2%. Three-day losing streak on both the S&P 500 and on the Nasdaq, the longest losing streak of the month so far. If you switch on the board and get to the bond market, 2-year, 10-year, 30-year, 2-year yields higher for 5 consecutive weeks. Not by much last week, though. I think you have to look at the 10-year for the major move. Up by more than 20 basis points last week on the 10-year. So we had that deep inversion. A bit of steepening, actually. Bit of steepening through last week, Tom.
Haven't talked about this. This is really, really serious. And I was sitting there Sunday going, what am I going to do? Is first thing look at the terminal Monday morning. And this is Bramo's World, the Bloomberg Total Return Index, the Lehman Barclay series at Bloomberg picked up. Really, really informative, John, just about what you're talking about. The worst was negative 18% down in price, a glorious major bond bear market. Well, we've recovered, but no, we haven't. We've rolled over in the last couple of weeks, as you say, higher yield. And the answer is now it's negative 13% from the peak in bonds. Have we broken through to new gloom? No, but we're there.
Bit of a potential pain trade emerging there, given that people were starting to lean into duration, taking on the 10-year, believing yields would drop off the back of this recession debate. But the data's been pretty decent relative to expectations. Even if you have a look at a payrolls report on Friday, I mean, let's face it, if you take out the ADP report, that was still pretty solid. Pretty solid to see payrolls where they were and unemployment as low as it was. Let's finish on foreign exchange. The euro looks a little something like this. No drama, pretty much unchanged. Just south of 110, 109.59 on the euro against the dollar. Plenty of data this week, plenty of Fed speak too. A slew of Fed speak on the way today from Barr, Mester, Bostic, Daly. Ahead of CPI on Wednesday. JP Morgan's Bruce Kasman writing the following. We should see global core goods inflation fall sharply in the second half as the disinflationary impulses propagate. More broadly, the decline in global core inflation through the third quarter should not be extrapolated as robust labour markets, strong wage inflation and elevated near-term inflation expectations hold core inflation above central bank comfort zones, Tom, well into next year.
A smart insight here on the dynamics of price change. And to review here, there is inflation, there is disinflation, which is a lesser inflation. There is outright price decline, the great fear of, say, middle 20th century England, deflation. And there's this cosmic thing, which is only understood at Columbia University, reflation. Bruce Kasman, first in his class on reflation at Columbia a few years ago, joins us right now. Bruce, it's a question out of the time of Greenspan, but here we are. People will go, OMG, China, deflation. Can we import deflation? Can we import deflation from China or on a global slowdown basis?
I think we can definitely import deflation in goods pricing, and I think there is definitely a force at work, which is related to China downshifting, the yuan going down, and perhaps more powerfully, simply the unwind of goods price pressures in a world in which manufacturing has been contracting. So I think goods pricing not going to deflate, but there's a deflationary impulse. I think the problem is that other things are going to be blunting that downward movement and keeping core inflation on an underlying basis probably around 3%, perhaps a little higher in the U.S. and globally as well.
Are we beyond the pandemic?
I think we are hopefully beyond the pandemic from the point of view of its impact on behavior, but there is reverberations from this which are powerful and profound. I think what you're seeing in the U.S., for example, right now is in the employment report, a moderation in some of the post-pandemic recovery sectors, leisure and hospitality perhaps being the most notable. But I don't think that transition and that decline in growth of jobs is a sign of shifting from strength to weakness. I think it's a sign of shifting from strength to more normalization. I think it'd be a mistake to use the normal business cycle dynamics and try to attribute that to the move towards an early start of a U.S. recession.
One consistent aspect of both the ADP and the jobs report was the strength in the wage figure that was far beyond what the Fed would like to see. And this comes on the heels of people worried not about the year-over-year comps, which I do see coming down because of rents and because of used cars and things of that nature, but because there is this wage pressure underlying some of this strength and some of this ongoing inflation. How much are you factoring that into how high real rates, neutral rates truly are?
So I would be a little bit hesitant to put a lot of weight on the swings at average hourly earnings, which went down sharply earlier this year and have bounced back up. But I do think wage inflation in the U.S. is running above 4% on an annualized basis. That's too high to be consistent with getting inflation down into the mid-twos. I would not argue that wage inflation is the primary driver of U.S. inflation, though. I think there's an issue here of tight labor markets. There's an issue here of psychology having shifted. And I think the interaction of those things in the absence of a slide into recession or something like that is just going to blunt some of these unwinds that are happening here. And we shouldn't ignore that as well. We were running inflation at the core 5% this year. I think we're going to slide below 4, but I don't think we're going to slide on a sustained basis below 3.
How long is it going to take to get there below 3?
I think it's going to take a recession to get there. I think you have to hit pricing power pretty hard. I think it's a mistake to think that the primary thing you need to do is create unemployment. What you need to do is hit pricing power. Unfortunately, when you do that, you change labor market behavior and the unemployment rate will go up alongside it.
Are rates restrictive enough right now where they are to induce some sort of recession?
I don't know. Might be. I don't think the Fed's going to wait around, though. And I think in our forecast of the Fed boiling the frog, they don't wait. They continue leaning against this. They tighten again in July and possibly more later this year. And by the time they're done, rates will be high enough with a lag to create a recession, probably sometime in 24.
Is your study, Dr. Kasman, that the modern Fed will react to higher interest rates? Do they actually, if we breach through and we start talking a 6% level for early ages, whatever it is, if we get a higher interest rate structure, does the central bank respond?
Well, I think when you look at the move up in 10-year yields we've been seeing in the last month or 8 weeks, I think some of that is a tightening in financial conditions as we reprice the Fed, but some of it is also taking out recession risk. And you can see more broadly financial conditions moving up. And I think in that environment, it's very hard for the Fed to look at that and say, okay, this is lags in the monetary transmission mechanism, and we can be patient against that backdrop. So I think the Fed is, as you can see, struggling to figure out where is the right degree of restrictiveness in this economy. It's probably going to be moving too much, at least in the context of trying to preserve an expansion because of the inflation news. And that's eventually going to take us down. I think it's just really hard right now to get the timing and to be too cute about the level of rates that's going to end this cycle.
That's dead on. And I thought about this over the weekend. Bruce, are we asking too much of our central banks? By definition, they don't get the timing right. I think this is this absurdity that they're going to nail plus or minus 14 days. A turn in the macro climate is absurd.
Well, I think we're in a really difficult macro environment in terms of getting right the inflation dynamics, the appropriate level of what rates are. But I think the fundamentals here are relatively straightforward. This economy is resilient. It has elevated inflation. And I think the chances of delivering a soft landing here are pretty small. So there's every reason for the Fed to try to calibrate and try to deliver that kind of outcome. But ultimately, I don't think it's going to be successful. And ultimately, I do think we're going to need a recession. It's a question of getting the timing right, getting the rate path right, which I think everybody should realize is hard. People are forecasting recession starting this quarter. People have been very confident about forecasting recession. Forecasting a break in the economy like that is just not that easy to do.
There's also a question.
We should understand that.
There's also a question, Bruce, about what the trigger could be of some sort of recession. And I was thinking a lot about geopolitics over the weekend with Yellen in China. How closely are you watching the price of rare metals, of some of these sort of tit-for-tat focused areas of chips and the instruments, the commodities required to supply said chips?
I think it's very unlikely that that dynamic specifically will be the catalyst for recession. But I think your point is really important, which is recessions are about the Fed. Recessions are about the vulnerabilities of the U.S. private sector, and recessions are about shocks. Oftentimes those shocks are in the commodity space and energy specifically. And I think it's quite reasonable to say that the next recession will not only be about the Fed hiking rates, but it'll be about some shock that hits us. Again, shocks are not easy to anticipate, both in terms of when they hit and exactly where they hit.
How do you measure the vulnerability then of a financial system to a potential shock? Because that really is the key to how deep the recession may be.
So I think vulnerability is broad. It's vulnerability in the financial sector. And as we well know, we've got banking sector stress and credit tightening that's going on. We're not seeing that spill over to the broader financial space. And I think that's important. But vulnerability is also about where the private sector is. And this is one of the reverberations of the pandemic, is how healthy the U.S. and global private sector is, both on the household and business sector side. That doesn't mean they're going to be a strong engine for growth, but what I think they're going to be are buffers against the potential for a break, at least for the near term.
Bruce, love catching up with you, sir. Good to hear from you, as always. Bruce Kasman there of JP Morgan. Just a little distracted here by Max Kenneman over at HSBC.
What's he on?
Bullish and right in the first half. Let's put it that way. This is what he got to say on the second half. Contrary to expectations, the first half proved to be a good half for risk assets, and we see little reason to change our risk on stance. He goes on to say, for the second half, we see risks around macro data running too hot, far from recessionary expectations. Bramo, that's Max pushing back once again.
He's been correct. He's coming back. The idea of a positivity from what we've seen in the past from HSBC, which has usually been quite negative, highlights how much people are really changing their tune. We see risks around macro data running too hot, from recession, far from recessionary expectations. Again, does this mean the Fed has to counter it? Does this mean it's okay? Does this mean just bulls can keep on running?
Max Kettner, HSBC TK, staying bullish, it seems.
Yeah, well, I think there's a lot of different opinions out there. Mike, again, as I've said, I believe in the resiliency of what's going on. And, you know, we're going to get it Friday with JP Morgan. We're going to launch into the week following. Maybe 10 days out from there, we'll have a lot better handle on, you know, the gloom that's out there. I go to the bar chart from bar chart that says there's a lot of gloom out there. The strategists are really cautious.
You love this bar chart, don't you?
No, I just like the chart. It says with Calvasina, Wilson, all the other Costin, all the other, you know, Gina Martin Adams,
sure,
what they're all saying, and they're all really there's the bulls are a lonely group right now.
Getting lonelier based on a price action. I think Bruce did a great job, by the way, in the last 10 minutes, really putting his hand on the tension on the FOMC at the moment. The point of division amongst participants. Do you believe in the long and variable lags, the amount of tightening of the pipeline over the last 12 months and change, Elisa, or do you think we've got to do more? And that's the debate they're going to be having, right, beyond July and through the rest of this summer.
And what we're seeing right now in terms of expectations in the market is a peak Fed funds rate of 5.4% and staying there for a couple of months, and that coming around November. So again, people are saying, yes, they've got to do more. But do we misunderstand the vulnerability of this economy to rates, or perhaps just the sort of immunity of it? I mean, no, I'm saying the resilience of it.
I think we have to get away from this binary recessionary debate. If you look at manufacturing right now, there is a recession. You look at services, there isn't one. If you look at good prices, they're rolling over. You look at services prices, you've just been away, sticky and robust.
It's ridiculous.
And look, it depends where you look. And I've had a lot of people write into me, particularly over the weekend, talking about these rolling recessions popping up here, there and everywhere. And if you just have this singular approach, which is recession, yes or no, and that's your debate, and you take it from there, I think you're missing a lot that's going on in this economy at the moment.
I agree. What I really noticed is Greifeld couldn't tie Bramo's shoelaces. Greifeld tried to do the gloom crew.
Did she have a go when Bramo was out?
Yeah, she had a go at it. She tried. She didn't get to the edge of toxic brew, but...
Did you give Katie that feedback?
Oh, yeah, I gave her that feedback.
Sure, that went
you got
down
to
really
be more
well.
gloomy. It works. It's so showbiz.
Is that the requirement for anyone that sits in Bramo's seat?
I'll sit there and just tell her about
She looked to her right and said, what's this? I said, it's a Bramo cam.
Equity's a bit softer. From New York, this is Bloomberg.
The big strategic issue is that Ukraine wants membership in NATO. Should it get membership in NATO?
I don't think it's ready for membership in NATO. I don't think there is unanimity in NATO about whether or not to bring Ukraine into the NATO family now. at this moment in the middle of a war. I think we have to lay out a path, for the rational path, for Ukraine to be able to qualify to get into NATO.
President Biden speaking on CNN over the weekend, coming into a key week for him in the UK at the moment, alongside the British Prime Minister Rishi Sunak. Later this week, on to Lithuania for a NATO get-together. We'll get to that in just a moment. If you are just tuning in, welcome to the programme. Equity futures just slightly negative, down by 0.2% on the S&P 500. A few days of weakness to close out last week, coming into a new week. And Tom, softer once again.
It's softer once again, and I think more than anything, it's a compendium of it. You mentioned foreign exchange before, and what's critical on a Monday is there's not much information from foreign exchange, and that's okay because we're waiting for CPI Wednesday. That's the next big step.
PPI Thursday, loads of bank earnings too. Then bank earnings moves over to tech earnings to close out the month of July. Federal Reserve decision in between.
Yeah.
TK, I'm getting excited. You're cutting in. Just let me
exciting.
build up the enthusiasm going into August.
We're enthusiastic. Are we close to August already?
Just in terms of the calendar, thinking about it, sure. Have you got a vacation planned at some point? Are you taking some time off?
No, I'm not taking any time off.
All right.
I'm the father. Everyone else is spread
Everyone else
around
goes
the world.
away.
Yeah,
they go away.
They're like in 6 time zones, and I'm at home with that bill.
Nice.
It's what it's like. This is important. This is a conversation, particularly for our American listeners and viewers. It was buried this weekend. There's something going on in Europe. Expert on this in the moment is Maria Tadeo. Our Bloomberg Europe is getting more conservative correspondent at the distraction of Lithuania in an important conversation with the leader of Lithuania later. But far more, Maria Tadeo, all eyes quietly are on the Netherlands. Mr. Rutte is out the door. Why?
Well, Tom, and I think you nailed it. It's a shift that we're seeing across Europe, and this is not an opinion. You just have to look at the elections and the election cycle. The European Union is tilting to the right, and Mr. Rutte had a spat with his coalition over migration and quotas, and today he has decided he is going to leave politics. Obviously, this is a shocker because Mark Rutte was seen as a very smart and also very smooth operator. Obviously, he can probably tell the wind is changing in Europe too, and he's leaving. But this is someone with incredible experience, more than 13 years in office, and now leaves a gap in the Netherlands. And I think, to me, even today, operational, we're not even sure who's going to represent the Netherlands here in NATO. And of course, as you know, anything that happens here has to be ratified by all the allies. So I think this speaks again to some of the turmoil that we see in the European politics, as I say, in the shift that we're definitely seeing with the continent turning to the right.
What does it mean for the big nations of Germany and France? In the United States, we had a president who got very discreet and tried to build a wall to Mexico. You can't build a wall in Europe, can you? What are they going to do about migration in Germany and France?
Look, technically in some places you could, but the problem is that some of the progressive voices will tell you those are not European values, those are not our European standards, and obviously we don't want to do anything that President Trump suggested at one point the U.S. wanted to do. The issue here, of course, is that when it comes to migration, this is becoming now a toxic debate, and you see it in the public opinion, again, changing and wanting tougher measures. I think when you see a lot of the turmoil play out in France over the past weeks, when you look at the situation in Germany, obviously, Olaf Scholz is not polling well in that coalition. Well, obviously, this brings about a new debate as to what to do with migration. But this is a never-ending issue for Europe, Tom. And ultimately, the issue comes down to the fact that nobody at this point wants to take in more migrants. Essentially, that is what it comes down to. It's not politically correct. It's very tough. It's very crude to say. But ultimately, that's where Europe is at.
And this underscores a shift to a sort of more conservative viewpoint, more on the right side of the political sphere in Europe. How does this debate, Maria, color the NATO discussions taking place in Lithuania, where you are, starting tomorrow, at a time when there's a lot of disagreement over how to proceed with respect to Ukraine and NATO?
Well, Ukraine is one big issue, of course, but today, if I have to be honest, it's about Erdogan and Turkey. That is the zeitgeist this morning, especially now because we hear from the Turkish president, what is a power move on behalf of Turkey, suggesting, okay, if you want me to say yes to Sweden joining NATO, then we have to talk about the European Union and Turkey. And you know very well there is very little appetite at this point in the European Union to talk about Turkey joining the European Union. And I suspect European leaders will say this makes things very difficult.
it's not the time nor the place to talk about this, but also for Sweden now, this is incredibly complicated because there's their national security. But if Erdogan is serious about this EU component, well, they're probably going to wait a long time to enter NATO.
What would the sort of olive branch be? I mean, where are the sort of nodes of contention, but also the nodes of agreement of where there's going to be some sort of potential resolution?
Well, look, on the Turkey, Sweden specifically, we know there's going to be a bilateral meeting today between President Erdogan and the Swedish Prime Minister. Mr. Stoltenberg, too, the Secretary General, is going to sit that meeting. But remember, this was about legislation changes in Sweden. This was about Sweden proving to Erdogan that they are serious about some of those issues when it comes to potential terrorism, when it comes to the PKK, which is an issue that Erdogan really cares about. But now this issue of the European Union membership really changes the game. This was not in the debate. I have to say, when I woke up this morning at 5 a.m., I was not expecting this today. And obviously, it really changes things. If you make a connection between NATO and the European Union, it definitely makes things for the EU. And I'm not sure they want to get into this debate. Not right now.
Maria, just quickly, you catch up with the leader of Lithuania a little bit later. Walk us through what's going to be the topic of conversation.
Well, the medium is a message, and of course we have NATO happening in Vilnius. This is the heart of the eastern flank. This is a Baltic country, huge supporter of Ukraine, but also when you look at it on a map, it's right next to Kaliningrad that belongs to the Russian Federation, and it is right next to Belarus. So I think one of the key points that we're going to talk about is Prigozhin. Where is he? And also, does he worry about Wagner potentially operating out of Belarus? That is something that you can really feel here. There's a sense of what is going on with Wagner, and what about Prigozhin?
Maria, only you can say this. The way you say the eastern flank, what does Central Europe think about redeveloping, redeploying military assets, material, to the Tadeo eastern flank?
Well, I think they would probably say yes, and I would point to a speech that Emmanuel Macron made in Bratislava just a few weeks ago, in which he said there isn't a Western Europe and an Eastern Europe, it's Europe overall. The fundamental issue, however, is that this is a continent, and you know this well, that did not spend enough on defense for a very long time. So even if you want to move some of those capabilities to the Eastern Front, the question is who's going to make them? Do we even have enough? And what is going to happen with the European industry? We need more, obviously. That is what European leaders will say, but then obviously the question is, what about the money? How do you finance this? And you have to really think big about the next 10 years.
An important conversation coming up a little bit later. Maria, looking forward to it. Maria Tadeo there with Lithuania's president, the host of the NATO summit taking place this week. That conversation taking place, Tom, I understand, a little bit later today.
Language is everything. And I'm sorry, when we say Eastern Front, you know, it's Hollywood and movies and the history of this war and that war. But just to hear Maria Tadeo say that's chilling, the eastern flank, and that's where we are in this new world. We day in, day out, we have to remind ourselves this has all changed.
The reality of things for those countries involved, Lisa, you wonder what the dividing line is over at NATO at the moment for those countries that would support the president's effort to provide this new weaponry to the likes of Ukraine when others are trying to push back.
It's a complicated debate, especially because of the type of weaponry that the U.S. government is looking to provide, cluster bombs, which have been banned in other places and have been really castigated for some of the negative effects. However, you take a step back, there is a difference between supporting Ukraine and bringing it into NATO now at a time where that would essentially bring the entire NATO membership into war. Right, into war with Russia. So a lot of people are saying, wait until the war is over, and then we can discuss this, and probably, you know, we can have a real conversation. But that's the tension here.
This sounds like a non-starter, TK, for most people.
Raging debate steeped in history. Good morning, Ambassador Haas at CFR, with the great leadership they've done in thinking about this. And the answer is it goes back to, I believe it was Belgrade, 2008. Condoleezza Rice and others saying, be patient, go slow. And America didn't, and some people attribute that to the jumpstart of how Putin responded.
Coming up very shortly, Alifia Dorawala of the Rock Creek Group. Look out for that in the next hour. We'll also catch up with Mandeep Singh of Bloomberg Intelligence. He's got a lot to say on Threads, Instagram's effort. How will Elon Musk and Twitter respond? We'll get TK's take. I know you're all itching for that. We'll get that in the next hour. From New York City, futures just slightly negative. This is Bloomberg.
high is the Fed going to have to go? Because the Fed's not going to quit until the labor market quits.
The data clearly suggests that the Fed needs to continue to tighten.
Depending on what we see from the inflation data, we could see another rate increase.
There's still a long way to go in terms of bringing inflation back down to the Fed's target.
Things are moving in the right direction, but gosh, we really want it to go faster.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Getting your week started here live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly negative, recovering just a little bit off session lows. We're down by 0.1% on the S&P 500. Just a few days of weakness to close out last week, Tom, and we start this morning with a touch of softness as well.
We started with a touch of softness to get to a CPI on Wednesday and on to earnings on Friday. And it's not that Monday and Tuesday don't have value, but I think it's, churning off of the jobs report. I thought Dr. Kasman from J.P. Morgan was brilliant there. The mysteries of that jobs report, the way it cut both ways, and it gets to a CPI report that may cut both ways.
The CPI later this week, PPI as well. I've been talking about how earnings season begins with the big banks on Friday. What's the big risk for the second half? Max Kettner of HSBC in the last hour publishing this one, Lisa. For the second half, we see risks around macro data running too hot, far from recessionary expectations, he says.
Maybe the ADP report's correct. Maybe this is the issue, is that suddenly we have an economy that still has a lot of steam. I will say that based on the tourism industry that I partook in last week, it seems like it is a very robust economy, and it is internationally so, which kind of rebounds upon itself. There is this question, though, of how much the Fed's going to respond to it and how that factors into market pricing. Do we have to worry about the Fed again? There was about a month where people were less worried about the Fed, and suddenly that seems to be changing.
Any crazy airline stories from your travels?
No, which is fantastic.
That's good news.
Elaine Becker wanted to know that.
The only thing is that when you travel an unnamed family-friendly airline, there is an announcement that comes on that says, if there's any inappropriate behavior, please alert us, which was really interesting to me, where I didn't necessarily get on some of the other airlines.
Cough Delta, maybe.
Hey,
maybe Delta.
I'm trying to be subtle here.
Maybe.
Can we talk about a shift here, which I think is germane to everybody worldwide? And John, you're living it terribly in the United Kingdom. And that is, it's not the first thing I looked at this morning, but the 30-year mortgage rate with its jump condition and rates is out 2.6 standard deviations. That's a huge deal for the fancy people and the middle of America. 7.38% on the bank rate 30-year mortgage. And John, this goes to your observation, which someone codified this weekend. I was shocked at the percentage of mortgages under 4%. This completely confirms, this is some hard data, folks, on what John's been talking about for weeks, and the basic idea that I believe it's 70% of mortgages are 4.00% or under. I would have never guessed that.
That's the question we've got to ask, right? Who's paying it? And this is the problem the Fed's got as they try and tighten policy and slow this economy down. At least how and where are those interest rates biting?
And the same debate goes to corporate debt, because a lot of the companies haven't refinanced and don't have to. So they're still paying relatively low coupons, just like people who are staying in their homes, not moving. Those houses are not going for sale, pushing up prices, and people are not paying those higher rates. So at what point does it bite? Does it bite soon enough to really inflict the damage necessary to bring down inflation?
My issue is, and I think Jeff Curry was the interview of the second quarter on this at Goldman Sachs, the new rate regime, the new rate environment, for us, it's a Bloomberg surveillance financial exercise. Let's do a data check. Let's look at 14 spreads. This has real impact across the real economy, as Jeff Curry said about a barrel of oil and the cost of moving commodities.
Home builder stocks get the joke. Just on the housing issue, they get the joke. Those stocks are absolutely flying year to date on the S&P. On the S&P right now, futures are a little lower, trying to recover here. We're down by 0.1% on the S&P. Lisa, yield's basically unchanged as well. We're still north of 4% on a 10-year.
Right now, what we're looking at is the discussion that President Biden is having with UK Prime Minister Rishi Sunak. They are meeting today. Some initial communique out of that meeting. Our relationship is rock solid. This, according to Biden, couldn't be meeting with a closer friend and a greater ally. We've got a lot to talk about. A lot of that has to circle around Ukraine. Today, the Fed speak. The parade of speakers. Fed Vice Chair Michael Barr at 10 a.m. San Francisco Fed's Mary Daly at 10:30 a.m. Cleveland Fed President Loretta Mester at 11 a.m. and Atlanta Fed President Raphael Bostic at noon. And at 3 p.m., this will be interesting. Credit card data How much are people just spending on debt, on leverage? The Fed releases the latest consumer credit survey for the month of May. The previous one showed an increase that was far beyond what people expected. This, to me, is really a key question, especially as I look at my, own circumstance, just in terms of, points.
Second time you've brought that up
no.
in the last hour.
You go on these vacations, then you look at your bill and you're like, oh my goodness.
I know.
And then you think, all right, well, I'm getting at least a lot of points. And
did some of that over the weekend.
Yeah, it's pretty intense.
I know. TK's saving. TK's been saving. Not contributing to the U.S. economy, TK.
Oh, no,
this
when
year.
you're across 6 times. The Keene family is spread across 14 hours of time zones. We're on the far side of the world. We're at camp. The camp is the thing that kills you.
Oh, it's ridiculous.
You get an
just
email.
didn't have camp as a kid. That just wasn't a thing.
Well, we had camp,
you were
and
given,
it was like...
you had a bicycle and a football, and you were left to make a summer of it.
And we had,
that was it.
If you were big spenders like George T. Keene, I got $10, which went a long way for Mars bars. Now I'm getting an email, can we do Chinese takeout for 16? She wants to buy, Afterthought wants to buy Chinese takeout.
How long's camp? It's like a 4-week
Forever.
4-week
I can't
vacation.
afford it. There's 2 camps. There's lacrosse camp at Disney World where you go away for a week, but it's 4 days. That's the other swing.
Yeah, it costs
That's the
$20,000.
racket. Yeah, and then
You're
there's
joking.
No,
it's ridiculous, John.
Camps can cost $10,000 for a month.
You have no idea what parents put up with.
Yeah, I don't do that. I sent them
the summer racket is just numbing.
Let's say specific segment of U.S. society.
Yes,
let's be clear
correct.
on that.
I think it's a hardship for a lot of society. I mean, it creates a lot of employment for people. I'll give them that. But, there it is.
All right. Joining us now, Alifia Dorawala, the Managing Director at Rock Creek Group. Alifia, wonderful to catch up with you. Big rally year today. We've talked to a couple of people about whether they think it continues. Can it broaden out? I was looking at your notes, and you were saying remain overweight US, underweight EM. Shorter-term positive view on Europe. Let's start with the US and break it down that way. Why remain overweight the US after big gains already this year?
Yeah, look, I think investors have been investing, as you mentioned, in a new regime from the last 10 years, right? We're in the higher rates, higher inflation for longer. But if you look at equity markets, while we're cautious on equities in general, after a very strong first half, what's going to break the equity markets? I think consumer spending is something that we're looking at very closely to see if that's what breaks equity markets. But I think we also have to remember that within the equity markets, the bull market this year has been driven by 8 mega cap stocks. It's more than 70% greater cumulative return in the top 8 stocks versus the rest of the Russell 2000 year to date. Seems immune to Fed action. So when does the party stop?
Alifia, I want you to take a long-term view. Let's be honest. If your leader, Ms. Beschloss, went to Marrakesh in the IMF meeting, people would just simply stop to know her opinion on the linkage of the global economy and hydrocarbons. When you guys look out to a 3 to 5 year look, do you have the gloom of the IMF? Do you share their view of tepid global growth?
I think growth is going to happen in particular niche sectors and areas. So we are investing quite a bit right now in alternatives. It continues to be very interesting. Investors can take advantage of those secular long-term trends. U.S., Europe, emerging markets. You see tailwinds from the IRA and climate infrastructure projects. You see huge innovation in AI. You see things happening in agriculture technology, healthcare, data centers. As you mentioned, companies producing renewable fuels for rails, terminals, livestock. There are so many interesting investment opportunities today, but they are not going to necessarily make you money in the next 3 months.
How do you sort of navigate the idea of being less positive over the next 3 months, but very positive, particularly about the U.S. over the longer term? How do you tell and communicate that message to investors who are not looking to day trade?
We manage very institutional portfolios for endowments and foundations, and they are long-term investors. They want their endowment to be there for the next 50, 100 years so they can continue doing the good work that they do. And so diversification in an institutional portfolio is key, especially in this type of uncertain environment. Think about it just in the public equities market. If you had taken a very singular view of small cap stocks, you would be missing out entirely on the first half of this year's rally. So you have to be diversified, we think, but you also have to look long term and start to plant the seeds now for those areas that are going to really be your biggest return drivers in 10 years.
It feels like diversification is changing, the meaning of it. And the people who we talk to, it used to mean stocks and bonds, and now it means private credit, private debt, some other private equity, other aspects, real estate, that really are coming to the fore, becoming more mainstream and have been over the past couple of decades. But from your vantage point, how has the idea of diversification shifted?
You know, that's a great question. And again, the flip side is that there's a lot of money chasing some of those opportunities that you said as well, right? So, you know, I wouldn't say that we want to just run into diversification for the sake of diversification, but it has changed because in any particular period of time over the last 10, 15, 20 years, you've seen one of those asset classes really be able to drive returns in your portfolio. Even today, fixed income, right? There's a spread between shorter term and longer term bonds, about 1 to 1.5%. Maybe you can do something there, eke out a little return in fixed income even today. So diversification means something different today because I think that if you don't have allocations across different asset classes, you will end up getting in a hole in a certain period of time during the market, and then it's very difficult to climb back out. And again, we're looking longer term. We want our endowments to be there in 10, 15, 20 years.
Well, let's talk about something longer term. Just finally, the geographic diversification. Japan's getting it done year to date. Tough week more recently over the last 5 sessions or so. But Olivia, where are you on that country? We're hearing a lot of people say they're starting to get interested.
You know, Japan's funny. I think over the last 20 years that we've been investing, there's been fits and starts in Japan. And the question is, can Japan really start to change their economy, change the demographics, and really get out of the disinflationary environment that they have had over the last 10 years. If they can do all of that, then there's a chance for Japan to continue on this path. But I think it remains to be, it remains, I think, a question on whether they can actually get those things done. And in the meantime, it is a stock picker's market, probably more so in Japan than in the U.S. or emerging markets today. If you look at the dispersion, for example, in the U.S. equity markets, there's more dispersion on a single stock level in the Japanese market today. So from a stock picker's market, it's great right now. I think longer term, we're going to have to see whether there's some fundamental changes in the economy.
Nikkei, year to date, up 23%. It's not bad. Olivia Darawala of Rock Creek. Olivia, thank you on the latest. Still constructive on the United States. This question mark over Japan. Lisa, so many people talking about the same thing. I've heard a lot of people start to think about allocating a little bit more to what's developing there.
Yes.
I heard about that from Steve Pagliuca. He was really hot in Japan, has been investing tremendously in that nation, not only because of the fact that you are starting to see some growth and inflation that we haven't seen before, but also because perhaps a knock-on effect of some of the labor, some of the manufacturing, some of the dynamism moving out of China into other regions could potentially also bolster that economy.
Well, this is critical, John. They got a new governor of the central bank. I don't think it's a small matter.
Don't disagree. Yeah. I don't disagree. If you are just tuning in, welcome to the programme. Equity futures right now on the S&P 500, negative 0.05%. Coming up very shortly, coming up at 7:30 Eastern Time, Gennady Goldberg of TD Securities on interest rates, on the future of the bond market, the Federal Reserve decisions as well. Just a final word on Japan. I think the people who have been there all year are probably thinking, Bramo, yeah, if you're interested, maybe it's time for me to get out after a gain of 20% or so.
Especially if you have the idea that perhaps there could be some abandonment of yield curve control in the future. And what does that do suddenly if you've got rates going up? Do people go in, or does that disrupt some of the models of companies that have been built on cheap debt? I mean, how much of the debt market does the Japanese central bank owns?
Oh, it's ridiculous, that number. And Japanese ETFs.
Is it a Japanese bond market? I would suggest.
And stock market.
John, you've been great on this because of your coverage on the real yields. See it with Katie Greifeld on Friday. And the answer is there isn't a Japanese bond market.
No, there are Japanese bonds.
But they're owned by the government.
The market piece of it, I haven't been sure about for a while. Yeah. Tom Kennedy of JP Morgan Global Wealth Management next hour. Don't miss that. Equity futures right now, negative 0.1% from New York. Good morning.
I believe that my bilateral meetings served as a step forward in our effort to put the U.S.-China relationship on a surer footing. I do think we've made some progress, and I think we can have a healthy economic relationship that benefits both of us and the world.
Janet Yellen there, the U.S. Treasury Secretary, after concluding her visit to the world's second largest economy. China. Your equity market more broadly to kick off things this morning, and good morning to you. Equity futures just about unchanged on the S&P 500. 3-day losing streak to close out the session on Friday. Payrolls a bit softer relative to expectations, a whole lot softer relative to the blowout surprise crazy ADP report the day before, but still leaving the door wide open for the Fed to hike once again later on this month. Before we get to that Federal Reserve rate decision, we do have some economic data for you. If you are just joining us, we've gone through these dates a few times, but happy to do so again. Wednesday CPI, Thursday PPI data, and then the bank earnings start to come through on Friday into next week. You know the arc of earnings season, you get the banks first, and then, Tom, we move over to tech later on in the month.
Apple, August 3rd, I looked that up. Are you aware that Ed Ludlow pulled a short straw for the Sun Valley Conference?
No, why?
He goes to Idaho, and it's like hazardous duty. I mean, it's seriously, he's got to wear rattlesnake boots up to his knees because in the summer, the rattlesnakes come out. And he's like, I'm the one. I did this with David Gura years ago. Years ago, David Gura.
Who's David?
David Gura is on the lawn at the Sun Valley Conference, and everybody's in their Patagonia trying to,
Tom, when they leave, they don't exist anymore.
Yeah, the great and the worthy and that. and I'm worried about Ed Ludlow's health here.
I'm sure he appreciates that, Lisa.
Let me guess, you're volunteering to save him
Lord,
the trouble, and that you'll head out there instead.
We're letting Bramo go. We're letting Bramo go. Let's do this. Let's get to something serious this weekend that's in the ether and is actually really, really important. There is a strident agreement in the United States that China's the bad guy, giving perspective this morning. Enda Curran, Bloomberg global economy reporter in Washington, truly encyclopedic on the Pacific Rim. And I was really taken away by the aloneness of Janet Yellen. As chair of the Federal Reserve, she is our arch labor economist. The loneliness of her as Secretary of Treasury. How lonely was she on U.S. policy in Beijing this weekend?
Well, she's certainly framing all of this through the economic lens, Tom. She, in Beijing, spoke all about the need for, guardrails, deepening of communication, pushing this line that the U.S. measures against China are not about economic containment. They're actually quite targeted in the areas of national security. And, of course, she spoke about it's not about decoupling, it's about de-risking. But even within de-risking, she acknowledged China would have concerns, and she's willing to listen to those concerns. So all of this messaging coming from Beijing over the weekend, as our colleagues reported, doesn't quite gel with some of the more hawkish rhetoric that we hear here in Washington. But it does underscore this idea that the administration seems to be putting some kind of a guardrail, or at the very least, getting lines of communication open again between both governments.
One of the great realities of landing at PNG in Shanghai is you realize there's goods trade with Shanghai and with China. Can Yellen or Biden or anybody in the future in America partition a tech dialogue from the massive manufacturing goods dialogue that we have with China?
Well, this is where the big complication is. Treasury Secretary Yellen is making the point that they're focusing on national security areas, and that might be AI, quantum computing, higher-end technology, Tom, like you mentioned, and maybe you can separate manufacturing from that. But I think the broad point is when you have tensions the way they are between both governments, it overshadows all economic activity. It overshadows the broad manufacturing sector as well. And that's why we have this ongoing discussion about our supply lines being reshuffled, our companies, MNC companies, looking to alternatives to China, for example. So you can make the argument that there's a narrow path and it can be navigated, but I think for business people, it's the broad sentiment that matters most.
Is there any way, that her view could really represent the mainstream in the Biden administration at a time where it is politically toxic for him to take anything other than a hawkish stance with respect to China?
Well, you would assume Ms. Yellen was clearly given license to go out and at least reopen these communications. She had about 9 to 10 hours of talks with her counterparts in the economic sphere in China, stressing this point about let's talk to each other. Ms. Yellen said they're willing to listen to feedback from China on the actions they take. Also, of course, the Biden administration has the 4-year statutory review of tariffs underway, for example. China's asking for those tariffs to be unwound. They're complaining about sanctions. They're complaining about economic containment. So, on the one hand, to give Ms. Yellen her dues, she might be just saying this is basic communication here about the basic efforts, not wanting to overstate it. But you'd have to say, against the backdrop of the ongoing hawkishness from the administration and politics in general, it doesn't quite gel with the picture we've seen over the last few years.
I was struck, and I wasn't as aware before some of these meetings, how dependent the U.S. was on the raw commodities from China to supply some of the chips that the U.S. is now saying they aren't going to send over to China. How does that complicate the issue? How does that give China a bit of leverage at a time when the entire economy is so dependent on these chips, on quantitative computing, on AI?
Yeah, it seems to be fueling this kind of tit for tat, Lisa. As you know, as we mentioned, the White House is considering further export restrictions and controls on investment. China responding with some talk of controls over some of those special minerals like gallium, for example, that you mentioned. So China is showing that they have some leverage too. But let's not forget how weak China's economy is at the moment. Those inflation numbers overnight, speaking to how weak the consumer is on the ground and how weak the manufacturing sector is. Surely China wants to do business with the world's biggest consumer, which is the US. So it's a question of how far China can push that leverage without cutting off its biggest customer.
Enda, thank you. Enda Karen out of Washington. The Treasury Secretary playing nice over the last week with China. Who knows what's going on behind closed doors, though? So much of this, Bramo, as you know, is for public consumption, particularly after the events of the last couple of months.
This is the second meeting by a high-level official in the past month from the U.S., right? Antony Blinken was the first. That was a couple weeks ago. And now we have Janet Yellen. The idea is we're trying to set a floor. Have we set a floor? Did we establish anything over the weekend, especially given the blowback in terms of the body language of Janet Yellen to some of these Chinese officials?
Meet and greet, we showed up, we showed the flag, and on you go. But I do agree that an economist, a legit first-order economist, doing a politician's job as Secretary of Treasury is unusual. Can you imagine some of the secretaries of Treasury that we've had, which were basically secretaries of commerce? They were business. They were CEO types over there doing it. I just think it's a different debate with the giant Janet Yellen.
You think Yellen's any different behind closed doors?
I think she's a tough... What's great about Yellen, I've seen this at the Economic Club of New York. I'm in the way back up in the cheap seats, and she gets upset. Ed Hyman will ask her some smart-ass question, and her voice changes, and she gets tough, Brooklyn.
I asked because Axios is out with a story this morning. Old Yeller, Biden's private fury. You read this yet?
No, I haven't read this.
It's nice, an interesting read. There's a quote in it. I think this is really funny. Some Biden aides think that the president would be better off occasionally displaying his temper in public as a way to address voter concerns that the 80-year-old president is disengaged and too old for the office.
Oh, dear Lord.
That's one way of spinning the message, isn't it, to Axios this morning?
That's something.
He should shout in public to get more angry.
Get riled up.
If I see someone at that age getting angry in public, I'd be more concerned about their fitness for office, wouldn't you?
If that's really the discussion, then we've got bigger problems. That's all I can say. No. I mean, if that's really what people are looking for.
I'm going to have a full-blown tantrum here.
Yeah. show us your vigor.
You done, TK? Okay.
I'm done.
Equities look like this on the S&P 500.
The tang
just about unchanged. That's what calms you down.
Tang.
That and bar chat. Futures right now, down by 0.1%. No real drama here. Yields unchanged. Let's call it 4.05% on a US 10-year. Let's see if things are unchanged by the end of the week after getting through a ton of Fed speak later today, which Lisa kindly went through just a little bit earlier. Then on to the data, CPI and PPI, to get another read on inflation in America going into this Federal Reserve decision later on, Tom, this month.
Well, we're going to have to see. I mean, it's a huge inflation report. And, you mentioned PPI as well. That's not a small matter. I used to ignore PPI, and I don't anymore. I mean, the linkage of the two inflation reports is powerful.
You certainly don't ignore it out of China at the moment. Disinflation, deflation, what are you calling that, Bramo?
Deflation, outright deflation. The risk of it. It's disinflation for now.
Keeping the door open to some stimulus potentially out of the world's second largest economy. Futures are lower as we kick off a brand new trading week. Good morning to you all. Live from New York City, getting your trading week started. Futures look like this on the S&P 500, on the Nasdaq too. On the S&P, just slightly softer, negative by 0.05%. The Nasdaq down by 0.2. Will it be a 4-day losing streak for both the S&P and the Nasdaq after closing down on Friday for a third day of losses. Plenty of banks publishing this morning, including Citi. US outperformance taking a pause. That's the headline of their read this morning. Our US strategy team thinks mega cap growth is set for a pullback. US recession risk could still bite. They raise Europe back to overweight. This is their take on Europe after the data out of China this morning. Europe is once again trading at a record discount and should benefit from a weaker dollar and any stimulus out of China. Their latest read, of course, following the latest PPI data that came out of China, the latest read on inflation in the world's second largest economy. You will have a read on inflation later this week from the world's largest economy, the United States. CPI Wednesday, PPI coming out on Thursday. Your bond market shaping up as follows. Let's slice and dice the yield curve up. 2-year, 10-year, 30-year. Look at twos. Your 2-year, 490.82. Your 10-year still north of 4%, with a big move last week, Tom, of more than 20 basis points higher on a 10-year.
On the vanilla spread, comparing the 2-year yield to the 10-year yield, we've really come in. We've disinverted from a negative 105, negative even 111 basis points, a full percentage point difference higher 2-year yield, lower 10-year, into 86 basis points. So there's been, I think it's been underreported this week, except by Katie Greifeld on the real yield. I mean, there has been disinversion.
Great show. Look out for that. 1 p.m. Fridays. Even now on a summer Friday, which is impressive stuff from Katie. Committed.
It is. Falling on a
program.
sword. You know.
Good for Katie.
It's doing well.
Great show. Look out for that. 1 p.m. Eastern Time on Bloomberg TV. Bloomberg Real Yield with Katie Greifeld. I want to finish on FX away from the bond market for a moment before Lisa gets you some single names. Your FX market just below 110 on the euro against the dollar, 109.57. We're negative 0.1% on a single currency. The euro actually, Lisa, last week showing a bit of strength to close out the week, even with high yields on both the 2-year and a 10-year.
A curious development as dollar weakness began to reassert just a touch. I want to take a look at some names that I find possibly more interesting than some of the macro stories. Rivian shares, the electric vehicle maker, up 3.6% in pre-market trading. Now, this is interesting because it has rallied 84% over the past 8 sessions. It has been on a record streak. This comes after the company said that it manufactured more EVs over the past quarter than expected, has shipped first time commercially outside the U.S. Tom?
Is it a meme stock? Is it like the theater stock that was before?
There is some substantial story underpinning this stock that people believe that it can prove to be some sort of significant competitor to Elon Musk. It has always felt that way.
John, I could just see this. I mean, she's up in the Adirondacks, and
with a Rivian.
The kids are outside the pup tent day trading Rivian.
They look like Ford Broncos.
But that's exactly it. They're
they look
kind
just
of
like
trucks.
a Ford Bronco, yeah.
And I know people who
Very good,
ordered them,
I didn't know that.
but the problem is that people would pay for them, and then they'd get them in 2 years, and then the manufacturing costs. Yeah, so the fact that they're able to deliver more is better.
We've got to stop there. Brown, I'm so sorry.
No, carry on.
I'm really sorry.
Please.
I just think we have to stop this EV climate change nonsense and just call them what they are. I mean, are they good for the climate, for the environment? It's driving me nuts. The branding around this is just incredible. It's so stupid.
You've made an incredible point, which is we have to address the size of a vehicle. And if we're looking for efficiency, it's probably not the best to just put a different kind of battery in if you're going to have, a Hummer. We can get into that discussion later.
Well, we should.
We will. And we will get into that discussion. We should have it.
I
will say.
So much. We'll do that later, John.
That was not how I said it. We will do it later. Alibaba, I wanted to take a look at some of the Chinese shares. They're down about 0.2%. They were down vastly more earlier today in the pre-market trading after the negative data that came out overnight from China. The risk of deflation potentially and slowdown in growth. What's interesting is that there was a feeling that perhaps the veil, the fog of concern was lifted from some of the Chinese tech stocks on Friday. That seems to be at least a little bit eased today. IEP, this is the most fascinating story of the day. The Carl Icahn Enterprise company up more than 9% because the Wall Street Journal is reporting that he has finalized agreements to decouple his loans from the share price of his company. So basically the fear was he had leveraged some of his purchases backed by the shares of his company. The more they went down, the more he could be susceptible to margin calls that could potentially spiral the shares lower. Today he came out and basically said, we've got a stopgap here. We're not going to be doing that. And so you're seeing the shares rise quite significantly.
Lisa, that's like a Wednesday or Thursday discussion. It's too much information for Monday.
It was interesting.
Spinning.
And again, I'm sorry for jumping in.
No, gosh.
Just I
not
think,
at all.
Sick to death of us having these expensive EVs shoved down our throat and we're told to save the world and spend however many thousands of dollars to go and buy one. I just think it's nuts. And then everyone, you see the leaders of various countries get together with the automakers. I understand the industrial policy, and that's really interesting. And I think they're really sexy cars in many circumstances, and perhaps get one if you want one. But this idea you're going to save the world by dumping this kind of cash into a massive Hummer, I don't get it.
I think that the size of the vehicle is very important, and I think you're absolutely right on that. There's a question of how to get the materials out of the earth and what's required to do that. There's a larger discussion that's important to have. I take your point.
I'm going to go to Michaelides in 2020. Here's the title of the academic article: Thermodynamics and the Energy Usage of Electric Vehicles. Okay, I got a quality C in thermodynamics. It's really tough stuff. It's really difficult. But I think, to your point, John, there's a lot of questions in the public, in the zeitgeist, not being asked on this.
We'll ask those questions through the next year, I hope. Let's talk about the Fed speak. Barr, Bostic, Daily Mester. Exciting stuff on the outlook for the Federal Reserve. TD Securities pushing out their recession call from the fourth quarter to the first quarter of next year, adding, given our new expectation for a downturn in the economy, we now look for the Fed to implement its first rate cut, drum roll, March 2024. We believe the market is sharply underpricing a potential for deeper cuts next year. The longer the Fed keeps real rates elevated at high levels, Tom, the more likely a hard landing becomes.
The calendar, the x-axis, and what we're going to do about it, seriously, about price of bonds. Gennady Goldberg joins us now, head of U.S. rate strategy at TD Securities. Gennady, I'm going to go to the outcome of this, which is TD Securities reaffirms with a vengeance curve inversion, and we could even get out to a steeper curve inversion down the road. What is the process that gets us to a deeper inversion?
Thanks for having me. Well, I do think that front-end rates remaining quite elevated for a while is what's going to get us there. I wouldn't be surprised to see it. It's been one of the most painful trades this year. I can't tell you the number of clients who've tried to enter curve steepeners here and actually haven't been able to hold on to that trade just because they're very expensive from a carry and roll perspective. What you can see is the front end of the curve continuing to actually move a little bit higher as the market has capitulated to the Fed's view of slightly higher for slightly longer, and that's very painful for the 2 to 5 year part of the curve. That's going to keep pushing up 2 to 5 year rates, and in my mind could keep the curve actually very, very deeply inverted for at least the next couple of months. And I can tell you, the steepening typically starts about 3 to 6 months before the first cut. At least that's what our research shows. Market right now is pricing in a cut actually even after us. We've got our first cut penciled in for March of 2024. The market's all the way in May of 2024. They're not looking for a cut anytime soon.
Gennady, is that including some sort of trauma to the financial system? Are you basically plotting in this idea that there's going to be some catalyst to that downturn that's going to prompt the cuts, and that's sort of the reason why you expect the deeper and sooner cuts than the west of Wall Street?
Correct. Typically, you do have higher rates acting in some unexpected way. We saw that back in March with the SVB crisis. I wouldn't be surprised to see more tremors in the months ahead. I don't think the market is looking ahead and realizing that higher rates, a real high cost of cash, 5% is not exactly cheap at this point. That tends to put some downward pressure on economic growth momentum. That could actually push the U.S. economy into recession over time. I do think people underestimate how much that can create shocks in the economy over the course of the coming year. I don't think we're quite pricing that in just yet.
Let's say we don't get any shocks, Gennady. Let's say that the economy is truly more resilient to higher rates than anyone previously imagined, and that companies continue to, as Tom would say, adapt and adjust. Then how high should rates go, and how high should they stay for a longer period of time?
Well, I think what you're describing right now is the nightmare scenario for the Fed. They think that they're right near the terminal rate. They're actually dancing around where exactly they want to dial into on the terminal funds rate. If inflation continues to rage, if there's no real impact on the economy, higher, much higher at that point, and that would be very, very scary. And honestly, the higher you push rates like that, the more likely you are to get downside shocks to the economy, to the financial system. Something on par with what we saw with SVB.
Gennady, people like you talk about the economic consequences of price down, yield up. I mentioned the Bloomberg Total Return Aggregate Index here earlier. It hasn't breached through to new price lows, but nevertheless, it's on the cusp. If we get bonds to go down in price, up in yield on an aggregate, do we get gamma? Do they have an accelerative behavioral tendency like equities where it picks up steam?
Well, you saw that back last year where investors were looking at their bond portfolio and saying, well, what is this? I thought these bonds were safe. You know, I don't think they were supposed to lose value, and they were down a very substantial at some point last year, they were down quite substantially. If that happens again this year, certainly you can have investors actually selling out. Interestingly enough, the rates are now attractive enough where a lot of investors are going in and saying, you know, even though I think rates can go a little bit higher in the short term,
that connection's back. I thought that connection had gone.
I thought it was good too.
No, you're back. You're back, Kennedy.
Okay, perfect.
Please
I was going to
thought.
say there's a lot of investors who are, you know, really looking at the bond market and saying, you know, these yields are quite attractive, even if they back up a little bit more, even if I'm down a little bit on my bond portfolio, I'm looking ahead to the next 1 year, 2 years. And that's why actually this year, despite the fact that the aggregate index hasn't done much, you've seen tons and tons of inflows. Right. You've seen over $120 billion flowing into the fixed income space overall, and really not a lot of outflows. So I don't know if there's necessarily that kind of moment that happens with fixed income this year.
Gennady, I just find it fascinating. What's your 10-year yield call quickly here? What's a 10-year yield call out?
Well, as we're heading into the end of the year, we do think things start to slow down. The consumer starts to slow, labor market starts to slow. So we're looking for 3.25 on 10-year rates by the end of the year.
Gennady, appreciate it, and sorry for cutting it. It seems to be my thing this morning. Gennady Goldberg there of TD Securities on the bond market. Slight technical issue at the end of that conversation there, but you know that happens. It's live TV and radio. Just warming things up on the technical side. Yeah, just smoothing those issues out.
We aspire to the stability of the Bramocam. You know, I mean, on a technical basis, the Bramocam is just rock solid.
Because it's consistent in one note, right?
It's up and running. It's up and running.
There's film in the camera, 16 millimeter.
If you are just tuning in, welcome to the program. Equity futures on the S&P 500, just about unchanged here. We're negative 0.02%. Coming up in the next hour, 8:30 Eastern Time, Steve Risciuto of Mizuho Securities. He's going to have something to say on the economic data in the week ahead, the bond market, Federal Reserve, and maybe a read on what's going to happen with these bank earnings later this week. I remember, it wasn't too long ago, we were obsessed with regional bank earnings and what that would tell you about the future of the US economy. And no one talks about the sector anymore. Tom, they've moved on quickly.
You know, and I'm going to bring up Pac West here just because I remember the symbol, PACW. And I mean, you talk about dead, it's just like flatlined at 8. You know, it's flatlined. It went from 27 to 8.
I would argue that the bank earnings that we get, including the regional banks, they will become more in focus coming up. As soon as they come out, it's sort of the short-term memory of the market that it will be really important. Everyone will say, oh, my goodness, everyone has to watch this. Maybe more interesting than CPI, maybe more telling and instructive for what kind of dynamism there is and how much we have actually withdrawn some of the momentum from the economy. Because right now, we have had lowered expectations. Companies continue to raise prices, I can tell you firsthand. And so how do we see that play out?
You know what's great here, John, is the president drives a Corvette. You think the King of England, when they meet here in a couple minutes at Windsor Castle...
Has he arrived yet?
You think they're going to talk British Grand Prix?
They might do.
You know, the president's got to be into it.
They're going to talk about climate engagement a little bit later on.
Really?
With philanthropists and investors. For those of you interested, later on this afternoon. So
a lot of people.
Look out for that. An engagement between the President of the United States and His Majesty King Charles III.
Threads, can it get critical mass?
I think it's going to be very difficult to get critical mass. I think right now the name of the game for Zuckerberg and Meta is just further expand the Instagram base in terms of the cross-sell opportunity, eventually advertising. They're trying to strike while the iron's hot, given some of the issues we've seen with Twitter and Musk. But getting the scale is going to be difficult.
Dan Ives of Wedbush, senior equity analyst. The latest tie-up, Meta launching Threads, or rather Instagram launching Threads, but the same thing going up against Elon Musk and Twitter. TK, you promised some analysis
update.
On Thread.
Here's
What's
my
the
analysis.
update?
They got to get their act together. The news business is in an uproar. You saw it clicking into Saturday evening, Sunday, etc., it's not Twitter. That's the major message over the first
The
weekend
review
of
is it's not
Threads.
Twitter. Can you write that up?
But you can't. It's way too hard. It's way too soft. I got way too many people drunk at parties on Saturday because it's an Instagram feed into Threads. I don't want that. I want to know what our competitors are doing, what the zeitgeist is, and it's not there. They don't want people like the three of us.
Would you like some more of this? The President of the United States, Tom, just meeting
He's
with
on
King
Threads.
Charles III, Windsor Castle. U.S. national anthem, I'm told, is playing.
Mm-hmm.
President's hand across his chest.
Damien from Billions saying "God Save the King" at the Grand Prix.
What did you think of that yesterday? I wasn't impressed by that at all.
No,
It was
didn't do it. I
bizarre.
was going to defer to Mr. Farrow.
Don't defer to me. I'm no expert on national anthems, but that was odd at Silverstone yesterday.
This is really something. And seriously, the tension here, folks, is of course Mr. Biden's affection to Ireland. A little bit of delicacy here. This is the king of the United Kingdom after his, and I may speak out of turn here, after his coronation in Scotland in the last week at Edinburgh. So there's some emotion here.
Just to go through the next few hours, Tom, so the President will participate in a ceremonial arrival and inspection of the Honour Guard with King Charles III. I understand there's also going to be a private meeting with the King at Windsor Castle. Then later, this was the climate engagement story I talked about earlier, Tom. The President's going to participate in a climate engagement with His Majesty King Charles and philanthropists and investors
off the
at
pandemic,
Windsor
and
Castle.
particularly off the war in Ukraine, has the debate of climate, COP25, 26, 27, etc., has it adjusted and changed? And what will these leaders do about a new debate over ESG, a new debate over climate change, still while the war goes on?
And how involved will King Charles be in that effort? We know as the Prince of Wales, Tom, he made a big push on that front.
But you change as king, I believe. You change as president as well. The imagery here at Windsor Castle, and of course it brings back John, the funeral of the king's mother, and late on that afternoon, the final private ceremonies for the family at Windsor Castle. I mean, it's the history of it. It's the history of it away from Buckingham Palace.
We'll step away from some of those pictures now, and if we get any headlines a little bit later on this morning, we'll bring those headlines to you. The President making a stop in the United Kingdom. He'll go from there, Tom, to Lithuania. Then the focus is really going to shift towards all things international relations and NATO.
I'm Maria Tadeo in Lithuania with an important conversation with the leader of Lithuania coming up here on Bloomberg Radio and television. Right now, we looked at technology. Mandeep Singh gives us a brief here, and there can only be one brief, and that is the Twitter Threads mandate. I don't mean to make jokes about this, Mandeep. How unusual is it that one billionaire copies the platform of another billionaire?
Well, so there is a history. If you look at what Facebook has done or Meta has done over the years, they have been very good at copying features or just iterating on their core apps. And they did that with Snap. They've, to an extent, done that here. But look, I think it just goes to show that Twitter as a platform didn't have the kind of moats that you could argue Meta has with the engagement they have on Instagram. And maybe this is an idea for them to, do something similar for Pinterest as well. So it kind of opens the doors for anybody to go out there and experiment with a new app. Now, we know Mastodon and Blue Sky didn't work because they never got the traction going. So in the case of Meta, they clearly got that transfer over from Instagram to Threads, which is why you see that 100 million users in the first week.
Which raises a question of, could it potentially be a Twitter killer, or is it going to be distinct and a separate entity? Tom was talking about how it doesn't necessarily have the same tone as Twitter. I concur with that. I think it's much more chatty, people kind of having to give their take and personality, and much less of, here's the facts, here's the data, let's have an economic discussion. I mean, is that how it's geared?
I mean, it's still week one. And look, I think one change you can see with social media is there is a lot more AI-driven algorithms than it was, before with the user graphs. And Facebook, to their credit, did realize that, as they realized the engagement declining for Core Blue app, they did pivot to AI with Reels, and now they are doing the same with Threads. So the thing about AI is there's obviously a lot going on in terms of innovation, and your moat isn't as strong as it used to be with user graphs because that was more data-driven. With AI, it's like anything you can do to train your algorithm for better recommendations, that's going to help your engagement.
But how does this really feature into whether this is a Twitter killer? I mean, a lot of people are saying this, and certainly Elon Musk has demonstrated some deep-seated insecurities over the weekend with some tweets. I'm just curious, from your vantage point, do you think that this is truly going to annihilate their business model from a much bigger competitor?
I mean, look, with social media or any consumer app for that matter, it's all about engagement. And if they are able to take engagement away from Twitter, that's going to hurt. And look, the time spent on social media apps isn't growing. User growth has stagnated. So in the end, it's a zero-sum game. And in Meta's case, they really needed something to drive engagement. They tried that with Metaverse last year. I think this is probably the answer for the near term. And they may look for more drivers down the line. But Metaverse, we know, was a flop. This thing definitely is showing a lot more momentum early on.
Just to build on Lisa's line of questioning, it's really difficult to break this out. But Mandeep, we've got a number of new sign-ups to Threads. But I want to understand how much of that is new numbers to Instagram and how much of it is just people coming over from Instagram and spending some time on Threads. Then the number becomes maybe less impressive.
I mean, you're right, John, that first week it was really onboarding existing Instagram users, but there are network effects. And look, Facebook has 3 billion users across their family of apps. Even if they convert, 20, 25% of their daily active user base, they're probably going to bring over a lot of those Twitter users and more. And that's the power of their platform that no one else has. I mean, Alphabet could have tried to build something similar as well, and they failed with Google+. They probably may be thinking that they could do something similar as well, because there are only very few platforms that have over 1 billion daily active users across their platforms, and they are the ones who can try out a new app and, port over their existing users to the new functionality.
Mandeep, love your coverage and insight on these topics. Mandeep Singh there of Bloomberg Intelligence. What's the number over at Twitter, monthly active users? Something like north of 300 mil?
It's about $330 million.
We're getting close, aren't we?
But it's, exactly. In just, a couple of weeks, you've got 100 million. That's the estimate. The latest estimate, as Mandeep was talking about. If those are active users, is that the end? I mean, is Elon Musk facing $40 billion of useless loans that he's got to repay?
You'd have to think, Tom, he starts making some changes, starts taking some advice.
Exactly what I thought.
I haven't decided on Threads personally. Another Meta product.
Oh, I have. I don't get it.
But I mean in terms of actually using it in the same way that I'd lose Twitter.
I want to get it. I can't.
The point that you just made there, Meta used to be the bad guy. People were talking about Facebook and Instagram, how they were collecting too much data and had too much power. Suddenly, people are cheering for Threads because they were that fed up with Twitter, which just shows you how fed up with Twitter people have been. But are people concerned about giving one company so much power?
Oh, come on. They want to make it lightweight and fun. They don't want to make it the news organization is. Let's be honest, folks. And our team in the control room, when news breaks, we use Twitter with attribution because it's the fastest thing in the world. From legitimate news sources, that's where you learn it as news is breaking. Are we going to say that about Threads?
Don't know.
Yeah.
I mean, I honestly don't know. Just from a personal standpoint, I'm still making my mind up on whether I'll actually... I don't want to be on another platform hosting garbage. Take a walk, get some fresh air,
get some points.
Take up golf.
I think, that
I might take up golf again. I might start playing golf again, instead of Threads.
Oh,
yeah. Why not? You want to come play with me?
You see me
play golf, you and I? Yeah, why not?
Get the knicker thingies
What about tennis, Tom? Bit of tennis?
He's
Wimbledon inspired you? He's good at tennis.
Yeah, I've seen him inside the bar.
We're calling for a soft landing and not recession.
We're still pretty cautious in terms of whether the Fed can pull off this soft landing.
When it all goes wrong, it's going to go wrong pretty quickly, and that's why the Fed may have to reverse course very, very quickly.
You have to worry that you might be too restrictive for too long.
They're going to end the year closer to 6 than they will to 5.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene all together again on radio, on television. CPI Wednesday upon us, and then earnings begin on Friday. John, I'm going to call it a quiescent Monday, but there's this tension in the air.
Got to build on last Friday, Tom. Did you put more weight on the wage growth? more weight on the low unemployment rate or more weight on the declining payrolls figures we're starting to see just a slowdown? We see at the headline.
Lindsay Piegza, it's no words about it. Wage growth, that's where she's looking.
That's number one.
She's the number one thing. And you're back to what Neil Dutta, the optimist, has said was, okay, wage growth comes down, but if disinflation, witness CPI Wednesday, comes down even faster, you get flat to actually true wage growth. Will we see that?
That's going to guide your call for the Federal Reserve going into the meeting this month, looking for a hike. Most people are. Then beyond into September, bit of division. Citi say hike, Morgan Stanley say no. And Adam Zentner and Morgan Stanley say no because they think the slowdown you're seeing in jobs, Tom, will persist. And ultimately the bar to get that next rate hike from the Fed after this one, they won't meet it.
TD Bank making clear when they cut out into 2024, they will cut with a vengeance. Lisa, what did bonds indicate to you over the weekend as you came down from the 7-carry Racket River portage?
With lots of mosquito bites. What I'm looking at right now is a market that looks, or at least a bond market that looks very similar to where we were right before the bank crisis, right? We have reversed almost all of the declines in yields, all of the expectations of rate cuts. We have priced them out. We're now pricing in the same kind of terminal 5.4% rate by the Federal Reserve. But stocks are flying. And this is the tension, I think, right now. Can stocks keep rising even if bond yields keep rising as well, even if bonds are saying a very different thing than stocks?
Well, they have done, haven't they? And that's been the difficulty that so many people have had. Yields are up, rates are up, home builders are flying. Let's pick a sector, pick an industry group. The home builders are flying because interest rates are high, so everyone's staying in the home they've got because they don't want to remortgage the house or get a new mortgage. So new houses are doing great and the housing recession's over. Is that right?
That's correct. That's perfect
Nuts.
summary. I mean, it just demonstrates how complicated this moment is and how so many people get it wrong. So one guest after another this morning has come on and said they're pushing out their recession forecast. They're getting more optimistic.
Doing that all year.
Right. It's like, and again, we're going back to, this is sort of going back to March 1st. We're back there again.
Yeah.
Within the confusion I see, and I'm going to go back, and this is ancient history, and I don't think it's an equivalent analog. I want to make that clear. I thought Lord Calvasina was brilliant, by the way, in the late 40s into the early 50s earlier. But what we're looking at here in the equity debate, and we're going to do that in a moment, is the second leg of a bull market. The first leg's easy to pick out. At some point, there's enough gloom, boom, up you go. But how do you get to a second leg? And to me, it's January of 1976. It's not that anybody saw 74 coming, or 75, I should say. It was a second leg, John, in January of 1976. Nobody saw that coming.
Are you looking for broader participation going into bank earnings?
I'm looking for corporations to adjust, and earnings
will they
once
adapt?
again will surprise. They will adapt.
Nice.
It's a broken record. I'm sorry.
It's all right. Do you want to check the markets?
Let's check the markets. I mean, red and green, the Dow up 35 points.
Nice. Equity futures on the S&P unchanged, recovering in the last hour or so. 3-day losing streak, longest since late June, something like that. In the bond market, yield just about unchanged on a 10-year, still north of 4%. In the FX market, not doing much this morning, I have to say. It's a bit of a snooze. The euro, Tom, 109.55 against the dollar.
I was going to say, right now, we're going to get started here looking at the equity markets. Chief Investment Strategist, J.P. Morgan Global Wealth, adjusts as he's adjusted. Thomas Kennedy joins us this morning. What's the key adjustment July 1?
I think your key adjustment has to come back to where you've been since Silicon Valley Bank. In those last, call it 90 days, what has really changed from the macro perspective is that working from home is a pretty attractive opportunity set for people. The supply side of the labor market in the U.S. economy has really improved. Participation rate in prime age, really trying to hone in on historic highs, but we've blown through the pre-COVID levels. But why does that even matter? It matters because your trend inflation level that we really thought we were fighting, about 5% during Silicon Valley Bank, has stepped down closer to 3.5%. So the macro community now has to really adjust to maybe the Fed's not fighting as big of an inflation problem as we thought just 90 days ago.
So what are we thinking about then? 3% is the new 5%, and the Fed's still got to go a little bit higher and growth's going to be okay?
So the Fed, I think, is still in risk management mode. So let's put that aside for a second.
Okay.
But what you have to acknowledge is that the Fed's job is to maximize employment and stable prices. That stable price level has come down. We haven't talked about it nearly as much as we did at the Silicon Valley Bank time, but core service inflation, core services ex shelter has stepped down to 3.5%. That's your best indicator of labor imbalance. And that one in of itself suggests there's a little bit more balance in the labor market.
Let's get to the market call. Is this another way of saying you're bullish?
I think it's another way of saying that the slowdown we are likely to get, 65% of all economists in your survey say there's a recession. It's so natural to believe that that's going to happen. You have interest rates far above anyone's estimate of what a normal time would be. But how persistent does the Fed have to make that slowdown? And if the labor market can come more into balance, they don't have to push nearly as hard. So this risk management mode for the Fed, I think, is part of the challenge that people are having.
But just to build on what John was saying, if that's the case, if we do seem to be having some sort of soft landing, do you pile into the equity trade as a good place to be?
I think you have to recognize what the market's pricing for you and say, where's your opportunity set? JP Morgan Community Wealth Management, one of the biggest pools of wealth assets in the world. 26% of all of our investable assets are in cash and cash equivalents. So we're trying to help people invest for the long term. That doesn't feel like the right opportunity set for them. What's the easiest thing to do? Is to buy fixed income. You buy a municipal bond, it's fine. On the equity side, though, where do you need to reinvest? For our clients, the community is wildly overweight tech, and we can start to find ways to rebalance them. Why? Because the rest of the market is actually pricing in a decent earnings downdraft.
What about the potential that we were hearing from Bruce Kasman, from others, about the vulnerabilities of a market at a time when borrowing costs are substantially higher and there is a lag effect? I mean, it's unclear how to measure that, but as companies have to refinance, as people have to move, they have to start actually recognizing and feeling the higher rates. How much are you expecting some sort of significant accident to interfere with some of these calls?
I think that risk is certainly elevated, Lisa. I think that's part of the reason why 2/3 of Wall Street think that you will see a downdraft. The question becomes, what do you do in the meantime while you're waiting for that? And equities can rally quite a bit during that time. What can you do to help get your investments to where you need them to be over the long run? And things, if the risk of a deep recession goes down, even if it's subtle, you have to make adjustments in your portfolio.
Right.
And opportunities, private credit opportunities, subordinated bank capital, and more of an equal-weighted S&P angle can help you get there.
There's got to be a huge percentage of people that feel like they missed this. I haven't asked this question. How did 60-40 do in the first half? And can you just stay a vanilla 60-40 forward?
The 60-40 did fantastically well. It was driven, to your point, though, on equities rather than bonds. But again, our clients are underweight bonds. How can I help them renormalize, diversify, Tom, and find a long-run strategic allocation?
Because they're looking at a total return. I mean, the reality is, here's how they think. They're looking at a total return of, let's say, 5, 6, 7%. And they're looking, granted, S&P hasn't participated, but all their friends own NVIDIA, and they're making 15, 18, 20% blended in a stock portfolio. That's why they're not buying bonds.
Market breadth has been a problem, without question, Tom. Every bull market, though, is a hated bull market. Every time we've been through them. And in this experience, though, I think we're just balancing where we were. I loved your anchor point. We have to go back to where we were pre-Silicon Valley Bank. And that shock to the system wasn't the thing that macroeconomists like me thought it was going to be. We have not seen the material slowdown in lending yet. It doesn't mean we won't get it. But you have to be able to balance out what the risks are, and the risks of a deep recession, I think, are lower than what they were at Silicon Valley.
This is critical. Tom Kennedy's calling this an anchor point. So if Bramo says something profound, we're calling it a Bramo point?
It's a Bramo point.
It's a Bramo point.
It's Bramo's anchor point.
It's a Bramo point.
Oh, boy.
Continue.
Bank earnings Friday.
Sorry, I set you up on that.
Tom, what are you looking for from bank earnings Friday with all of this in mind?
Bank earnings are going to continue to show a challenged outlook. You have, from the deposit side, banks are needing to pay up to shore up their deposits. And on the lending side, you are seeing lending growth slow. But remember at Silicon Valley Bank what we thought was going to happen. Small banks would slow their lending materially, and it's been the opposite. Large banks have slowed their lending materially. It's keeping all ourselves honest here. It is different, but the outlook for the economy is quite challenged. It's very normal to assume growth will be below trend until something happens and something breaks. That's what the Fed's goal is meant to be. In our baseline scenario, S&P 500 earnings below trend for 3 years, 2021, 2022, 2023. How do you start to move and adapt to what that world looks like? Diversify. Find good ways to get to your goals with a little bit less risk, and that's what yields are offering you.
Well, let's finish there. Top pick. Favorite thing right now in fixed income. What is it?
I think it's just core, boring, unsexy bonds. Munis, core IG. and you're locking in an interest rate of 5.5%, 6%. Look, our community doesn't love unsexy ideas, but you can get 6% and not take too much risk.
Tom Kennedy, good to see you. JP Morgan Global Wealth Management on fixed income. Going back to SVB. Tom, we've been talking about that the last week.
Yeah.
I wasn't here for much the last month. I mean, so I almost said the last month. I didn't talk about
what
that.
What did I miss here?
But did over the last week.
I don't think this is a marginal issue, and what tells me that it's still there is the stock price action. Given the healing of the bank system and the verbiage from institutional authorities, PacWest should not be flatlining like it is. It should have a bid to it. It does not.
There's a distinction between the risk for regional banks versus the risk to the broader economy. And what Tom was saying there, that from a macroeconomic perspective, the regional banking crisis was not an economic crisis and didn't have the bleed-through effect that many thought that it would. And I think that is what we're seeing priced into a lot of the bond market, at least, as well as potentially equities.
John, it's important there because you listen there for the Brammo point.
I always do.
The marginal Brammo point.
It was only a few months ago.
It
was only a few months ago.
When was the last time we were all together? I mean, it's Christmas.
It's been a month. I think it's been a month. It's good to have Brammo back around the table.
Yeah,
if you are just tuning into the programme, welcome to the programme. The S&P 500 turning positive 0.08%. Coming up at 8:30 Eastern Time, so 18 minutes from now, Steve Risciuto of Mizuho Securities pushing ahead to inflation data later this week. CPI Wednesday, Tom, Thursday, PPI.
It's going to be a great brief, no question about it.
That's your takeaway from Steve.
No, it's going to be a great brief. I mean, the guy's wicked granular. There's no question about it.
I've got 90 seconds on the clock and you give me 3-word answers.
Well, it's like I'm focused on the king and the president. I'm watching the king and the president.
I'm trying to adapt and adjust.
How's it going?
It's painful, like corporate America.
Steve Risciuto, let me explain this. Not only does he have the glory of having Dominic Constant with him to provide a great financial synthesis around it, but he is expert at digging into the dynamics of that algebraic GDP function. He's the best at it. There's no question about it.
Going into next year, as we push that recession call out and start to think about a second half, which maybe will continue to deliver, and we reflect on the calls that came in through the start of the year when we were thinking about dip and then rip. Remember that? And then it was just rip and then rip
some more.
A bit more.
Yeah, your in Timur Fidelity put out a note that I thought was really interesting overnight, where he was talking about how the market always inflicts the maximum pain on the maximum number of people. And the maximum amount of pain would be to flush out all the shorts, to have it rip higher, keep going, recession gets pushed out, and then eventually, when everyone's rightly or wrongly positioned, then it'll hit.
Krishna said last week, high yields, that's your next pain trade. Long end, 10-year. Happening last week at least, not this morning. 10-year, 4.0457%. Steve Risciuto, 16 minutes away.
It's my hope and belief that there is a path to bring inflation down in the context of a healthy labor market. And the data that I've seen suggests we're on that path.
Janet Yellen, US Treasury Secretary, speaking on CBS over the weekend to set you up for the week ahead with tons of economic data still to come. This from Stuart Kaiser over at Citi. Equity markets are a nominal growth plus risk asset, so continued positive economic data alongside stabilizing inflation is a positive combination for markets. We have had the first part of that, the positive economic data. You need the second part of it, stabilising inflation numbers. We'll see if we get that on Wednesday and on Thursday, respectively. At the moment, your equity market just about turning positive as we inch towards the opening bell, 1 hour and 13 minutes away. Equity futures here, Tom, up by almost, I say almost, 0.1%.
It's going to be interesting to see, and particularly to see how the equity market rebounds, perhaps, into the angst of, OMG, what's JP Morgan going to do Friday? But, John, it's amazing to me that we're 12, 13 VIX, and we've pulled back in this gloom to 15.31. 100 days ago, 15.31 would have been, a religious experience. That's how far we've come.
And Mislav Matejka talked about this over at JP Morgan, the low volatility, FOMO full swing, complacency being built into stocks with the VIX at the lows of its recent range.
Yeah, I wonder what global Wall Street, like Tom Kennedy was just with us from JP Morgan, what do you do to people who are up 4% blended, up 7% blended, going, Excuse me, sir, what are we doing? I think there's...
Well,
right
that's
now,
not enough after the double-digit gains elsewhere.
I just think that permeates the zeitgeist here of a busy summer. Somebody over the weekend in the Hamptons said there's no Hamptons this year, that Wall Street's just grim about the potential layoffs, the right sizing, whatever you want.
You went to the Hamptons this
No,
weekend?
I did not. I did not go to that.
You're talking about that article in Business Insider?
Maybe. I think maybe it was Shonali Basic's Threads account. She was on
the Hamptons?
Yeah, on the Hampton zeitgeist as well. Right now, and I want you to lean forward on this, Mary Lovely is hugely qualified out of Syracuse University, senior fellow at the Peterson Institute, to speak of the mysteries of China, including her leadership at the China Economic Review here a number of years ago. Professor Lovely, thank you so much for joining us this morning. I want you to sum the mystery now, the zeitgeist of China, the Pacific Rim, 3 or 4 big cities, and then all of that distance of China to the west out to Chengdu. Is China struggling? Is China flat on its back, or can we be more optimistic?
China is struggling. It is not flat on its back. It clearly is struggling. We're waiting for the Q2 numbers to come out in a week or so, and we'll know how badly it is struggling. But it definitely is struggling. It had a little bit of wind under its sails coming out of the end of zero COVID, but consumers are just not having it. And of course, the global economy has slowed. It has managed to have several good quarters with its net exports, but it's looking for drivers of growth, Tom, and
Right.
it's not going to find them in the households.
Is the hierarchy, and I'm going to use this phrase as an amateur, the hierarchy of the Communist Party, that all that matters is employing people?
No, very much not. It is, of course, preserving the rule of the Chinese Communist Party and preserving the role of the state. And of course, one of the key ways you would do that is to keep people employed. But we've seen some very serious problems with urban unemployment among college-educated youth hitting almost 20%. So they have a really serious problem in terms of driving jobs, not in the factories that were hit with the Trump-era tariffs from the U.S. Instead, this is in the service economy. It's in the higher tech sector. It's in finance. It's in the kinds of jobs that college-educated young people, were trained to do and expect to have.
Given this backdrop, Mary, how does that influence, how does that color the discussions, I should say, that were had with Janet Yellen, Treasury Secretary, over the weekend, the second high-level U.S. policymaker to head to Beijing in the past month?
That's a great question because, of course, the two intersect. The Chinese would love to see a decrease in tensions with the U.S. They would like to see some rollback in the Trump-era tariffs. Janet Yellen coming is good news. Not only is it's a further visit from someone very high up in the Biden administration, but it's someone they're familiar with. It's someone who has enormous respect globally, enormous amount of experience in the U.S., both at the Fed, now at the Treasury, and in other ways. And so they treated her, I think, with the dignity and respect that she's due.
Given that there is that respect on one hand, there didn't seem to be a lot of resolution to anything. Do you think that there were any inroads made over the weekend, especially given some of the blowback that Janet Yellen has gotten for kowtowing, maybe even quite literally, to Chinese officials in a way that perhaps people in the U.S. are not as interested in?
Yeah, that's just noise. If you look at it, she's an older woman, tiny woman. She's going up to shake hands. This is noise. She's there to actually do business. And I think that her main message from President Biden was that we are trying to put some guardrails on the relationship. We do have major disagreements with the Chinese, but it's a relationship we want to manage and manage in a way that doesn't lead us into higher and higher levels of conflict.
Mary, your Peterson Institute is led on thinking about an America that post-pandemic will adjust to a higher rate regime. Adam Posen and Olivier Blanchard really leading the charge on this. How does China fit into that? If we bring our general level of interest rate up, what does that do to China?
Well, it's clearly a challenge for China because it leads to a tendency, if they didn't have capital controls, you'd see capital flight as investors would try to get higher yields. So there's capital flight, there's pressure on the currency that they don't want. So that sort of takes their monetary policy and says, we have to do this with it. At the same time, they would like to continue to stimulate the economy. They've tried to do it with what's called targeting credit expansion, and they have a number of different individual pots of money for small businesses, for different sectors, et cetera. But they're still having trouble. That is not really having the effect on the economy that they're hoping.
Mary, thank you. We have to leave it there. Mary Lovely there of the Peterson Institute on the economy in China. We talked about the surprises of 2023 so far just moments ago in the market. This market's ripped. The Nasdaq doing tremendously well after a really difficult year last year. That's the market surprise. The economic surprise, what happened to China doing all the heavy lifting, Lisa? The reopening story, the boom we were expecting there to spread through Europe. And now we've got, what, Germany in recession? And China struggling. We're talking about stimulus in China in the middle of the year, really?
Right. And we're talking about not necessarily just a reopening, but a lack of willingness to invest, a lack of willingness to spend by consumers who can't find jobs, as we were talking about with Mary Lovely. Taking it a step further, how does this play into the commodity space and the importance there? The idea that we didn't see also the boom in energy prices, and perhaps that was a tailwind that offset the fact that China didn't provide the boom.
If you've got an answer for that, OPEC Plus and the Saudis would like to know.
I'm sure that they would.
Because, Tom, I don't think they're too happy that we're still down in the 70s.
Off the pandemic surge, I mean, we went from 2020 in the blended Bloomberg Commodity Index to a boom index. We've pulled back, and technically there's no way we've broken commodities to a higher visibility. No way whatsoever.
Great lineup in the next hour to get your week started. Amanda Lynham of BlackRock, Brian Levitt of Invesco, Samir Samana of Wells Fargo. Tom, those conversations coming up in about 35 minutes' time.
Be interesting to see. I mean, there's no question about it, what Brian Levitt does here in terms of asset allocation. And to me, I mentioned it earlier, the 60-40 conundrum for me, for a huge body of our listeners and viewers, I mean, this was gospel. You put 60 in here, you put 40 in there, and you play golf, and gone. It's evaporated.
You know the barbell now, Tom.
Yeah.
You put some money in some cash-like securities, you pick up 5%, you put some money in AI, and you do something more interesting than play golf.
I don't,
Surf. Yeah.
Go away for a long weekend.
Get points.
My essence here, John.
Lots of points.
And
they don't need to put that on a credit card.
We're having an October conversation in July. That's the heart of the matter.
Yeah. You're just skipping summer, aren't you?
Yeah.
No interest in summer. No vacations,
Kids.
TK. Okay.
Kids. Bloomberg Surveillance. Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We're all together again. Ferro's gone off to get ready for a 9 o'clock Cineramic escapade. It'll be wonderful to see what he has at 9 o'clock, given markets churning here. It's a churn before CPI Wednesday. Lisa Abramowicz and Tom Keene with you here. And it's a rich discussion, to be the least. And this morning, for those just joining in across America, it's real simple. It's about China, the whispers of deflation and disinflation as well.
To put it all together, there were a lot of weeks so far this summer where not a lot happened and people are just sort of spinning their wheels trying to come up with a new narrative. This week is actually going to be incredibly important with both the CPI report, the last week of Fed speak, and lots of it before the quiet period, the geopolitics of China and the U.S., potentially deflation there, but also what's happening with respect to the tit for tat between the U.S. and China. And then to put the boot on all of this, we've got Friday, we've got bank earnings kicking off. You put that together, that is a massive pivot point for people who are already reassessing and pushing out further recession calls.
To get out to Wednesday, and CPI Wednesday, we'll have complete coverage for you at 8:30 beneath the headline data. We stop Tuesday. It's something that we're not spending enough time on, which is the small business report, the NFIB small business report. What is the mood of people small enough to run their businesses off their charge cards, but frankly, companies that are bigger than that? I don't like the phrase small business, but this is the heart of America, many would say.
6 a.m. Eastern tomorrow, we do get that small business optimism survey. How not optimistic are people who actually have to pay the bills and pay higher salaries and find the workers and everything that we have been seeing when we do go on vacation, or if you don't and you just, play tennis in Central Park like Tom Keene every day with a cigar.
I watch them play tennis. I'm not playing tennis anymore, which is a good thing for the tennis community. Have you watched Wimbledon?
I have.
I have not watched
a little bit.
Brief me on it.
Well, I mean, just we will get more from there. But yes, carry on. CPI data, you're talking about that, due out on Wednesday. Stephen Risciuto of Mizuho Securities pushing out his recession call, among many others as well on Wall Street, to 2024, adding, without a rise in joblessness, the economy remains stuck on the current trajectory, which would eventually lead to rising inflation expectations and higher long-term rates, despite global excess saving. And Tom, to me, this is really the key question. The resilience that we see in businesses, the adapting and the adjusting, and the economy and the labor market, how much higher do rates have to go to really bring inflation down to where the Fed would like it to be?
And it comes to the granularity of Stephen Risciuto. He's chief U.S. economist at Mizuho Securities, and can be across the core equation, Y equals C plus I plus G plus something to do with net exports. But Risciuto, of course, in a recent note, goes much bigger and broader. I love how you push back against secular stagnation. That's the gloom that's out there, and you say America's different. Talk about America in the media frenzy on secular stagnation.
You know, the point behind the U.S. economy is the underlying resilience. The Biden administration, as well as the Trump administration, provided an enormous amount of excess savings into the system through the COVID stimulus. And there's still, by our estimates, about $1 trillion there, which contrasts easily with the San Francisco Fed number of $500 billion. But even more important than that, we have healthy balance sheets for the household sector and for the corporate sector, the non-financial corporate sector. And even when we look into the banking industry, despite all the regional bank hiccups we've seen, there's still a solid balance sheet for the industry in general. And I think that drives home the liquidity. So between the liquidity, the excess savings, the health of the balance sheet, this is not a credit crunch recession that we're anticipating. That's why it's hard to call the beginning of it. This is an inflation recession, which means the Fed has to get short rates high enough to choke off levels of economic demand, and they're trying not to do that. And the net result of that is they're slowing the economy but delaying the inevitable. So you run the risk that you could wind up with increased inflationary pressures built into the system. What they need to do is they need to get the belly of the curve up, because that's where securitization takes place. That's where everyone funds. They don't fund in the Fed funds market or in the 30, 60, 90-day market. They fund in the 3 to 7 year maturity gap.
I look, Steve, at the respect that you and I have for someone like Lawrence Summers, his early research on hysteresis with Olivier Blanchard, among many other accolades as well. But there's Lawrence Summers on stagflation. Should we worry about stagflation? It seems to be, is there something, at least a stagflation? Is that a word?
Well,
help me with stagflation.
I think you do have a greater potential for stagflation to unfold from this if policymakers hold on to this experiment that they're trying to run for too long, which is to craft a soft landing. You look at what the markets are doing. The markets are being very rational. The equity market's saying the Fed's forecasting a perfect soft landing. So they've priced in a perfect soft landing. You look at the curve. The curve is saying the Fed's going to keep on raising short-term rates, but then they're going to cut rates real quickly. So the market has this downward slope to it, and we were over 100 basis points inverted between 2s and 10s about a week ago, and now we're about 80 to 90. The difference is almost all of that downward adjustment in the curve is concentrated in the Fed funds, the 2-year to 5-year sector, which means a lot of the impact that you're getting from monetary policies not winding up finding its way through to the cost of financing for households and corporations.
You've said a lot that we have to unpack. The idea that this is not a credit crunch recession, building on what we heard from Tom Kennedy of JP Morgan, that the verdict is in. We have seen that the regional bank crisis was not an economic crisis and didn't have the ramifications for the economy that a lot of people believed. How high do you think the Fed has to raise rates for it to be restrictive in a way that it is not now?
It's a function of the curve. And to the extent that we have to get the 5-year note to current 2-year note levels, that gives you the impact. Now, how high does the Fed funds rate have to be to get there is the question. And that's a difficult question to answer. I do believe that if we had the 5-year note trading where the 2-year note is trading right now, we would have a very, very different level of macroeconomic activity. So that differentiation there then gets into, well, how much of a curve does the Fed anticipate a cut? And that's what's important about the dots in the SEP, because the dots in the SEP, although they did raise the level of rates, okay, they actually made the curve drop steeper over time. So they went from saying 80 basis points worth of adjustment downward to 100 basis points worth of downward adjustment. So they kind of took out the sting of what they were doing.
This all goes to, if you're just trying to parse through bond speak, this idea that the higher you raise rates in the near term, the more quickly you'll induce a recession that brings rates lower over the shorter to medium term, which offsets the actual effects of monetary policy. Correct. Where does the balance sheet play in then? Is that the other tool at a time when you have seen it actually accelerate in terms of its deceleration, of its decline?
Well, I mean, you got to remember, they've put so much into the system with the $5.4 trillion that they monetized, and the economy has grown. So some of that excess is being eaten up by the growing economy and the expansion that's necessary in the underlying balance sheet for the economy. But they've got more room to take out, but I don't think they have the opportunity to accelerate it, to be honest with you. I think there's a good degree of risk implied in trying to do both interest rates and quantitative tightening at the same time. And I think they would have been smarter to have just done one first and then done the other later.
When you talk about pushing out the recession, that seems to be consensus with a lot of people who we talk to. It's kind of obvious if you take a look at the data, which is not consistent with recession very much in most areas of the U.S. What is the nature, the contours of the recession when you expect it to hit next year? Well,
it's going to be very shallow, or it should be very shallow. They're not going to try to kill it. And that's part of the process. So it's an evolutionary process of trying to get there. And this gets back to Tom's question about stagflation. If you're not going to kill it and wring out the excesses in the system, you run the risk that inflation expectations get embedded in the system. And if inflation expectations get embedded in the system, then you could get an environment where the economy slows, but you don't necessarily get the full bang for your buck on the disinflationary side that you have. The benefit of the global deflation story, Tom, is it's holding down long-term real yields and nominal long-term rates. That's helping to keep the economy growing as well, because that continues to contribute to the idea that there's still ability to finance out the curve, and it's helping to invert the curve between 2s and 10s.
Let me squeeze this in. I got like 8 ways to go here and 8 questions. This is so interesting. Is the Great Moderation over? I mean, I just did a log concave chart of what the price of bonds has done according to the Bloomberg Total Return Index. And the slope, that acceleration of the Great Moderation is ebbed. Can we say it's peak done and we're going to cut down to a new non-Great Moderation?
That's a darn good question. I think the global deflation story is the key to that. And to the extent that we have expanded our production facilities by diversifying our supply chains in an environment where the global economy is aging, in an environment where the global economy is slowing. You do have cyclical inflation that's taking place in the U.S., Europe, and to some extent in Japan, but you have global deflation taking place outside of it. And it's that trade-off that's being reflected in the inversion of the curve. The long end's being held down by the global constructs. The short end's being pushed up by the domestic cyclical constructs, and that's the Fed's creating the problem by anticipating cuts. If they weren't anticipating cuts, we'd have a different macro
Help me
story.
here in July on getting to October. My first question to Georgieva at Marrakesh is simple. Given the IMF's 2028 gloom, which you just voiced with disinflation, how does America adapt and adjust to a global slowdown and global deflation?
It's hard. It's hard.
Agreed.
But we do benefit from the fact that we are the largest net importer. So we wind up suffering from the potential deflationary risk, which gets back to your question. Could we get back to the Great Moderation? The answer is, if they deal with the cyclical issues correctly, yes, we would get back to the Great Moderation. If they deal with the cyclical issues incorrectly, we could wind up with stagflation before we then have to deal with those issues and get us back to the Great Moderation.
Fascinating. Steve Rasciuto, thank you so much for a brief here from 60,000 feet on the American economy. Lisa, to me, and I thought about this over the weekend, the basic idea of John Williams reaffirming a low R-star, and I've been taken about how many people I respect agree with the president of the New York Fed that we can be optimistic and get back to some form of that Great Moderation with a sustained, more subdued R-star.
Ellen Zentner, the soft landing from Morgan Stanley. A lot of people talking about this, that the amount of debt the demographics, the aging population make it very difficult to see inflation gathering steam, which is the reason why I'm so curious about some of the geopolitical tensions that could raise prices of commodities in a way that we have not seen so far this year. Where do some of these other factors come into play when we start talking about the bigger underlying inflationary
It goes into the oil call very quietly here. Brent nudges up near $80 a barrel. I mean, did you go long while you were gone? Did you go long oil?
No, I went long airline futures and pretzel futures for all of the flights, which I think is interesting.
I don't know how you did it. I heard it was terrible. We will continue. Red and green on the screen right now. The VIX 15.41.
To pick up on that, though, I just want to say yesterday was the busiest day for commercial aviation ever recorded by Flight Tracker, which is this tracking mechanism online, which to me, I mean, again, that's sort of the tenor behind some of our discussion about inflation. Prices are higher. Experience, it's worse. Pro tip. And yet people want to travel and get out there and they're willing to do it.
You look at the celebration of Greek recovery and, of course, the Prime Minister, who's been a great supporter of the efforts of Bloomberg Surveillance, winning a resounding re-election. I guess everyone's celebrating. I saw an image of the Acropolis this weekend. I wouldn't want to be there. It's so touristy and crowded. You know, I just, why would anybody go over and wait in line for 6 hours when you bought a ticket 3 months ago?
The Vatican, the Acropolis. I mean, if you go to Rome, I mean, if you go to any of these, it's incredibly crowded from all accounts.
It really shows what Ferro did, where he went to 4 different islands and no one was there. It's incredible.
Yeah, well, I mean, but this to me goes to this sphere of if you don't have inflation globally, it could potentially simmer down. But since you have it so strongly in Europe, since you have it so strongly in the U.S., since you have it so strongly in so many places around the world, it gets harder to see how we get down to something that's more reasonable without some sort of more material intervention.
I'm in the camp that there's other factors out there like technology and maybe some American exceptionalism as well. I have to admit Europe is, to me, the biggest mystery right now, not the least because they have a war going. Later today, our Maria Tadeo in conversation on that Europe with the president of Lithuania. And again, Emery Horton scheduled, I believe, to be in Lithuania as well. The president is in London with the king. Stay with us worldwide on Bloomberg News. Good morning.
There's an issue here of tight labor markets. There's an issue here of psychology having shifted. And I think the interaction of those things in the absence of a slide into recession or something like that is just going to blunt some of these unwinds that are happening here. And we shouldn't ignore that as well. We were running inflation at the core 5% this year. I think we're going to slide below 4%, but I don't think we're going to slide on a sustained basis below 3%.
Our treasured team there, giving you the voices on a Monday morning you need to reset for the week. Bruce Kasman is chief economist, head of global economic research at J.P. Morgan. I really want to state that, on Friday, first of all, we don't plan for anything here at Surveillance, but the basic idea is somebody went to me or Lisa, you were in a Racket River somewhere, or Ferro, who was having a gelato, I think. They called up Ferro and they said, what do you want to do? And he says, I want to reset for inflation on Wednesday. And that's really what we're doing today.
I just want to say,
resetting for inflation.
You could go on vacation too, rather than just sort of lobbing these jabs in there about other people.
Time zones. I got 14 time zones I'm covering now. I'm home with vet bill and kennel fee. Getting it done.
I will say, though, I take your point about CPI and how important that's going to be. It's the last major data point before the quiet period and then the Fed. Although, and we were talking about this earlier, I think you brought this up, Tom, where we kind of believe July is a lock. It's going to be a hike. What about after that?
No, we're going to have to see. Red and green on the screen right now. 2-year yield 4.95 down from that 5.05. Shock here. We've heard a lot on interest rates today. Joining us right now, what's really good about this is her kids are at camp 2020 hindsight. Gina Martin-Adams joins us, chief equity strategist at Bloomberg Intelligence. 2020 hindsight, October of last year. What did Bloomberg Intelligence say about the equity market?
Well, our models did give us an indication that at the very least we were in a massive sentiment washout for the index, which historically are pretty good conditions to start taking on a bit of risk. At that point in time, our fair value model also suggested that the market was positioned for a 15% downdraft in earnings growth coming for the next 12 months. So really big earnings recession was priced into equities. And luckily enough, that earnings recession has not happened. We've seen earnings remain weak, but actually excluding the energy sector get a little bit stronger or at least less weak. And that's what's taken the market by surprise so far this year.
I went back in my youth and I looked, it was a week where I bought 2 Bob Seger albums. These are record albums, Gina. You're too young for this.
Got it.
Big record albums.
Noted.
And the hardest thing off the bottom in that pessimism is the second leg of a bull market. I identify it as January of 1976. Is this the second leg of a bull market? What are the attributes that will allow you to identify?
Yeah, we need to see leadership broaden beyond the top 5 in the index or even beyond the top 7 in the index to establish that second leg. We did see that occur in June. We saw a pretty significant broadening of the advance indeed. But I think there's still a great deal of nervousness as to whether anything other than the top 5 can produce some earnings growth into the second half of this year, which makes this earnings season pretty consequential. Because the top 5 is absolutely leading earnings growth. That segment of the index is expected to post 17% growth in EPS year over year. That's a big earnings gain relative to the market's decline.
Are modeling 17%?
The biggest stocks in the index.
But that really, just to build on what you're talking about, highlights the concern that some people have, which is that the largest companies are masking what's going on elsewhere. Does it make it difficult to talk about an index level when it's so heavily skewed and doesn't reflect some sort of mean?
It does, because when you focus only on an index level, you miss everything that's happening underneath. And this goes beyond the top 5 as well. Remember last year, everyone thought, oh, earnings are holding up much better than expected. But if you decompose the index and you looked at earnings ex energy, you saw a very clear earnings recession emerge in the S&P 500. We're having the opposite occur today. So I think it's extremely important to decompose the index into its constituent parts, look beyond even the sector level, look at aggregates in a very different way, because otherwise you're not going to get the investability right.
Which is why people are increasingly looking at equal weight indexes. And I've seen a number of reports, particularly over the weekend, highlighting that you're seeing actually a real comeback there as well, because people are looking for other places to put their cash in the FOMO that JP Morgan talks about. How can you judge whether that's gone too far if you just take a look at the bird's eye view?
Yeah, it's challenging, but I do think you want to look at things like valuations for the equal weighted index, which are still well below their pre-pandemic average levels. There's plenty of room for that valuation sort of level to re-rate outside of the big cap tech stocks and outside of the largest stocks in the index. I do think you want to look at earnings growth, excluding the top 5, which even when you exclude the top 5 and you look at earnings growth ex energy, you are starting to see some stabilization emerge. We need to see that continue. We need to see a bit of follow through into the second half of this year. We need to see the macro conditions continue to support that stabilization. And critically, this has been an earnings recession that's really all about inflation and not about growth. And I think that's left a lot of people on their back foot because we've been in an environment where growth was the only thing that really mattered. And now we're in an environment where inflation is predominant. And so it took a lot of people by surprise when the earnings stream turned out to be a little bit better than anticipated. And most of that is because of the inflation dynamic, which shifted materially earlier this year. We need to see that continue. CPI has to grow at a pace faster than PPI. Both need to continue to decelerate to really support this margin stabilization, which should lead to a broadening in performance and earnings at large.
I just brought up a small store out of Bentonville, Arkansas, and I'm looking at a PE on Walmart of 24, 26, something up there, which I think is just absolutely insane if it's growing at single-digit level. But I'm looking off the BQ screen. Folks, the BQ screen is where Gina Martin Adams goes every day on the Bloomberg terminal to become wiser. Price to cash flow of 11 times cash flow.
Yeah.
That's a lot smaller number. What does that signal to you?
Yeah, I think that this is really important, very important, because cash flow was under an extreme amount of distress in 2022 as well. And this is another thing that was completely missed in the sort of the consensus speak was earnings are better than expected, but cash flow fell throughout 2022 year over year. Cash flow is starting to improve. We saw our first quarter of improvement in the first quarter of this year. We should see cash flow continue to improve through the rest of this year. And importantly, investors are not paying for that cash flow. And I do think that that provides an opportunity for companies that can produce that bottom line cash flow growth for some multiple expansion. Now, is it for the overall index at large? Not necessarily, because you're still paying an enormous amount for some pretty grim cash flow dynamics for the broad index. But on a stock-by-stock basis, an industry-by-industry basis, there are tremendous opportunities.
And Lisa, to give you an idea, I got the HP12C out, folks, because if the day gig doesn't work out, I'm going to go work for Gina Martin Adams at Bloomberg Intelligence. Apple's free cash flow from pre-pandemic to a model of where we are now, it's only up 79%.
I know, it's been a tremendous rally. I take what you say, Gina, about the importance of both CPI and PPI, and CPI needing to rise at a faster price than PPI. Yeah. We get CPI on Wednesday, PPI on Thursday. This is another way of saying that they can keep jacking up prices more than their base costs. That's another way of basically saying the same thing. Dovetail that into Friday and the bank earnings and what importance you place on them at a time when people are looking to some sort of lending contraction.
Yeah, so bank earnings is a whole another story for what's going on in the S&P 500, because this is, like energy, one of the weaker components of the index where people are actually losing a lot of faith. Bank earnings expectations for growth have roughly been cut in half, a little bit more than half, over just the last 6 weeks, as investors are continuing to get very nervous about that. And this is about loan quality, it's about credit quality, it's about sort of deteriorating credit conditions. It is about growth more so than inflation, with the one exception of the inflation's dynamic on the inflation impact on the yield curve. So financials are sort of in this worst place sort of position because they've got negative yield curve spread. An inverted yield curve is terrible for bank earnings as a signal. They are not particularly expensive, but nonetheless, no one has any faith in the earnings outlook because of the risks that are still sort of underneath the surface of this economy, and that is credit quality is a real concern. Everybody's very worried about the degree to which credit quality can maintain some stability going into the second half of the year. Financials are therefore ground zero for this risk. And I don't think that's necessarily going to change in second quarter. We've seen no indication of change at all. So we probably will start off the quarterly earnings season with some relatively weak results and then have to ramp up into the stronger components of the index as the season goes on.
Gina Martin Adams, thank you so much. I got to go move on to a surveillance correction.
Okay.
Just to see if I can come back tomorrow. Kimon from Athens listening. He's with one of the major Athens banks. Thank you for all of you in central banking in Greece and commercial banking who listen every day to surveillance. He says, Tom, you're an idiot. And he says, I was comparing the Acropolis to Disney World, equating them. And I apologize if that was the tone that I took. I was not equating the Acropolis of 525 BC as compared to Pinocchio of 1949 AD. I didn't want to be disparaging to Mr. Mitsotakis.
Your apology has been recognized. Duly noted.
Can I come back tomorrow?
You can come back tomorrow.
Thank
Slide
you.
rule it all.
Sigh of relief. Good morning.
Yeah. Oh, yeah.